Welcome back to the audiobook series on Encyclopedia of Chart Patterns. We've already explored a wealth of patterns in the earlier chapters, and now it's time to continue our journey. In this section, we'll be covering chapters 31 through 40, diving deeper into advanced formations, their reliability, and how traders can apply them effectively in real markets. Let's pick up where we left off and continue uncovering the powerful insights hidden within chart patterns.
31. Double tops, Adam and Eve results snapshot. Appearance. Two well-defined peaks, the first narrow and pointed, the second wide and rounded, both separated in time but topping near the same price. Adam and Eve double tops perform better than average based on the performance rank of 10 where 1 is best. The double-digit break-even failure rate has a rank of 13 out of 36, not shown in the results snapshot, so it's good too. If you own the stock in a bull market and it double tops, you might want to sell or not, depending on the circumstances. Sometimes it may pay to weather a small decline after a double top, especially if the general market and others in the industry are soaring. Tour. Along with the head and shoulders pattern, double tops are perhaps the most popular. Many novice investors see a dual peak on the stock chart and proclaim it to be a double top. However, there are a number of characteristics that compose a true double top, and I will discuss them in a moment, but first, what does an Adam and Eve double top look like? Consider figure 31.1, a double top in Elk Corp. The first thing one notice is the twin peaks. They should top out near the same price and be widely spaced. The price trend leading to the first peak is upward, and price falls away after the second peak. Thus, the double top is a topping pattern and not a bottom. The intervening valley is just that, a valley that sees price decline by varying amounts, a median of 10%. I measured this. The valley floor forms the confirmation line or price. A twin peak formation becomes a true double top once price closes below the confirmation price, signaling a downward breakout. Sometimes a pullback occurs, such as that shown in the figure. Pullback allows investors another opportunity to exit their position before the decline resumes, but not in this example, of course, because price climbed. For more aggressive traders, the pullback is a chance to make a short sale in the hope that price will continue falling. Identification guidelines. Table 31.1 lists identification characteristics that Adam and Eve double tops share. They are only guidelines, not rules, and exceptions are many. Consider the double top shown in figure 31.2 as I run through the guidelines. Appearance. When searching for an Adam and Eve double top, remember that the Adam peak should look different from Eve. Adam looks like an inverted V, usually with a 1 or 2 day price spike poking out of the top. Eve tops are rounder and wider looking. Adam peaks come first, Eve second in this chart pattern. Price trend. Adam and Eve double top forms after a short-term price rise beginning in November. The average rise leading to a double top is 98 days, or about 3 months long, valley between tops. I set no minimum price decline between the two tops just to see if deep dips showed better performance than shallow ones. They do. The median dip is 10%, so allow variations. Figure 31.2 shows a 10% valley decline. Top high price. The price variation between the two tops is usually small, and some limit it to 3%. I placed no such limitations on the double tops I picked for testing, but they looked as if they peaked near the same price. The median variation is 1%. Top separation. Some will tell you that tops must be at least a month apart. Again, I placed no such restriction on the patterns I selected. However, the median distance was about 3 weeks as measured between the highest high on each peak. The double top in figure 31.2 shows peaks 46 days apart. Price decline after right top. This guideline separates double tops from triple tops. If a third peak forms before confirmation, then ignore the double top and check if it is a triple top. If it is a triple top, then do not trade it as a double top. Common sense, really. Volume. Volume is usually higher on the left top than on the right as measured by the 5 days surrounding the peak, 2 days before to 2 days after. If the right peak has higher volume, do not worry. It happens. The double top in the figure has higher volume on the left peak, breakout direction. By definition, the breakout is always downward in confirmed valid double tops. A twin peak pattern becomes a true double top when price closes below the confirmation or breakout price. They are the same. When confirmation occurs, it might be time to sell a long holding or initiate a short sale. Trading before confirmation may mean price continues rising after the sale. A study I performed said that happens 60% of the time in bull markets. So trading before confirmation may lead to a loss 60% of the time. Why do double tops form? Consider figure 31.3, an example of a well-shaped double top that satisfies all of the identification guidelines. Volume was unremarkable but did have its moments. On spurts, like that shown during March and again in April, volume spiked upward and buying demand propelled the stock higher. Unfortunate investors or traders bought near the atom top hoping price would continue rising, a momentum play. However, astute technical investors recognized the price pattern for what it really was, the completion of a measured move up. The first up leg occurred in just 3 price bars, followed by horizontal movement for several weeks and another swift rise to the atom top. With measured moves, and the main reason I treasure them, price often returns to the corrective phase, the horizontal movement midway up the pattern. So knowledgeable traders would have expected a drop from the atom peak, and that's what happened. Price formed a base in early May that saw a low of 15.75. The consolidation lasted almost 2 months on light turnover. The price decline from peak to trough was not much in dollars, but it represented a 20% drop. Comparatively, few investors took advantage of the price lull to add to their position or place new trades. Novice traders who bought at the top probably swore they would sell just as soon as they got their money back. When price started rising again, traders pulled the trigger and sold their shares as soon as they got their money back. The volume pattern, which up to this point was flat, bumped up and took on a more rugged appearance during late June and into July. Other traders, believing that the consolidation was over, bought for the first time. As price rounded over and formed the eve peak during July, some investors correctly assumed that a double top was forming. They sold their shares near the top, content with the profits they locked in. Other intrepid traders sold short and hoped price would fall. Price did fall but found support in August at the top of the horizontal price move located between the 2 double top peaks. After a prolonged attempt at creating a third peak in late August and into September, price gapped continuation gap below the confirmation point at 15.75. Price broke out downward. The smart money sold their shares immediately and licked their wounds. Others hoped the selling was overdone while still others sold short. The stock attempted a pullback in mid-October but gave up. For the next several years, price failed to rise above the high established by the double top. Figure 31.4 shows another example of a double top. The atom peak does not have a long one-day price spike. Rather, the peak is narrow when compared to the eve counterpart. Look at the width of each peak near the confirmation line and you will see what I mean. If the top shape does not make it easy to identify the pattern, look at the base's width. Sometimes that helps. At the confirmation line, the atom peak remains narrow but eve remains wide. Focus on failures. Figure 31.5 shows a typical failure of an atom and eve double top. Let's run through the identification guidelines to see if we have correctly identified the chart pattern, price trend. Price rises from the December low H to the atom top. Check. Valley between tops, price drops after atom and turns up to reach the eve peak. The dip from atom, the higher of the 2 peaks to confirmation at E, is 20%, which is plenty deep. Top high price, the price difference between the 2 peaks is minor, 0.2%. The stock looks like it's peaking near the same price. Top separation, the distance between the 2 peaks is 70 days, which is fine. Volume, linear regression says volume is receding from peak to peak, that is, it's higher on the left than on the right. I drew line D to show this. Breakout direction, it's downward as required. Confirmation, price closes below confirmation line E a day after touching it. Every one of the above checks passes the guidelines set for the pattern. So what went wrong? Price broke out downward and made it to A. A pullback happened that returned price back to B, meeting the breakout price. A pullback is typical, and they happen 64% of the time. This one made the journey back in just 4 days instead of the usual 12, and the stock didn't drop far below the breakout, either 5.2%, which is close to the predicted average of 6% for a pullback. After price reached B, the breakout price, it kept rising up to C. At C, a right-angled broadening and descending pattern completed with a downward breakout. This sent price back down to approach the bottom, E or A, of the double top again. After that, the stock climbed and closed above the top of the pattern. When that happened, price busted the downward breakout. The drop from E confirmation to A was slightly above the maximum price of a 5% failure. So technically, it wasn't a failure, but I would have hated to have shorted this stock or sold a long holding, expecting a steep decline. A check of the fundamentals shows that the company announced earnings at the atom peak. You can see how the market reacted to that announcement. The stock dropped for a month. The large drop F that took the stock down to E, the confirmation line, was because of the next earnings announcement. The market interpreted as good news the next earnings announcement at G. The stock gapped higher a breakaway gap and soared thereafter. I didn't see any news posted on the company website that explained why the stock turned higher at A. Apparently, the earnings report wasn't as bad as shareholders thought, or maybe optimism expressed about the future during the conference call. I'm speculating here, because I didn't check, helped convince people to buy the stock and halt the decline. I will say that in my trading, I usually ignore double tops. Why? Because the typical decline is meager. As I have aged, it makes more sense for me to invest in a diversified portfolio instead of doing lots of trading. I no longer need to day or swing trade when I can be riding my bicycle and making thousands. I will assess each situation. If it looks dire, where I would expect a huge loss, then I'll sell. In this figure, find point H in December. I consider this the launch price for the double top pattern. If I were looking at the stock the day after F the breakout and seeing the large drop after the earnings announcement, I'd be afraid the stock would continue lower, retracing most of its gains down to H as a worst-case scenario. Statistics. Table 31.2 shows general statistics. Number found. I found 784 Adam and Eve double tops in 533 stocks from July 1991 to February 2020. Not all stocks covered the entire period, and some no longer trade. I consider this chart pattern rare. Of the 4 combinations of Adam and Eve double tops, this one has the fewest bull market samples. Because it's rare, bear market samples are too few to show, so the number found is for bull markets only. Reversal R. Continuation C occurrence. Since we are dealing with double tops and downward breakouts, all patterns act as reversals. That means price enters the bottom of the pattern going up and the breakout is downward, reversing that uptrend. Average decline. The average decline is slightly better than the other 3 combinations of Adam and Eve double tops. It's even better than the 15% average for all chart pattern types, not just Adam and Eve varieties. Standard and Poor's 500 change. Using the dates of the breakout to the ultimate low, we see that the S&P 500 dropped an average of 4%. Maybe that drop explains the slightly better performance for this pattern. The falling market helped drag down stocks, days to ultimate low. It takes about 7 weeks from the breakout to reach the ultimate low on average. Median is half that though, or 27 days. That may assist you in the timing of the decline for your situation. How many change trend? This is a measure of how many patterns see price drop more than 20%. The higher the number, the better. Comparing the rank of the results shown in the table says that this double top is in the top third of the list, 11 out of 36. That's quite good. Table 31.3 shows failure rates. 1 in 5 trades, 21%, will see price fail to drop more than 5% after the breakout. That rate doubles to 43% for patterns failing to drop more than 10%. Is it any wonder that I no longer fear seeing a double top? Keep this table in mind if you decide to short a stock. The decline may be less than you think. If you own a stock, check this table for the likely decline. Is it worth holding on to the stock and weathering the decline? Only you can answer that. Table 31.4 shows breakout-related statistics, breakout direction. By definition, the breakout is downward. As you know, a breakout occurs when price closes below the lowest valley between the 2 tops. If price closes above the top of the pattern first, then you don't have a valid double top. Yearly position performance. Price drops farthest if the breakout is within a third of the yearly low. Avoid those with breakouts near the yearly high. Although that may sound strange, shorting a stock making new highs can be a disaster. You want to hunt down weak situations in stocks making new lows. Pullbacks. Pullbacks occur almost twice every 3 times. When they do occur, price takes 12 days to complete the journey back to the breakout price. However, a pullback hurts performance. For example, double tops with pullbacks declined 15%. Without pullbacks, price declined 17%. This finding suggests you should search for underlying support before investing. If you are considering shorting the stock and the decline stops in the support zone, would that warrant the risk of a trade? Price resumes the downward trend just over half the time. Gaps. The appearance of a breakout day gap suggests better performance, but not so you'd notice. Table 31.5 shows pattern size statistics. Height. Tall patterns perform better than short ones after the breakout. To use this finding, compute the height of the double top from the tallest peak to the lowest valley between the two peaks. Divide the height by the price of the lowest valley between the two peaks. If the result is greater than the median shown in the table, then you have a tall pattern. Width. Didn't see any performance difference between wide and narrow patterns, but I will say that wide patterns tend to perform better than narrow ones in many other chart pattern types. Height and width combinations. As one would expect, tall patterns outperform short ones regardless of whether they are wide or narrow. The numbers say to avoid short and wide patterns. Table 31.6 shows volume-related statistics. Volume trend. Volume trend from peak to peak is downward, which I found using linear regression. Rising and falling, breakout day volume. There's not much performance difference if volume is rising or falling, or if the breakout day volume is heavy or light. Table 31.7 shows how often price reaches a stop location. I divided the double top in half and found how often price climbed on its way to the ultimate low. May sound odd, but I wanted to know where to place a stop. Sticking it at the top of the pattern will see price trigger the stop 1% of the time, but the distance between your entry price and the stop location might be huge. So not only determine the best place for the stop, but check to be sure you can tolerate such a loss. Table 31.8 shows the performance over 3 decades. Performance over time. 1990s showed the best performance, handily beating the other 2 decades. So if you have a time travel machine and can go back to the 1990s, you'll know what to expect. Failures over time. Failures, 5% failures have grown steadily worse over the last 3 decades. It makes me wonder what the future will bring. Can I borrow your time machine to check? You're probably telling me that there's no future in time travel, but I digress. Table 31.9 shows busted pattern performance. Busted patterns count. Almost half, 40% of double tops will bust. That's painful if you are expecting a significant decline. Busted occurrence. Most of the double tops that bust do so only once. In second place is a triple bust, triple plus, really 3 or more busts, busted and non-busted performance. I compared the performance of busted double tops with Adam and Eve double bottoms. Single busted tops beat the performance of double bottoms. All busted patterns means the performance combination of all busted types, single, double, and triple plus patterns. If you can find a busted double top, consider trading it, especially if you believe it'll single bust. Trading tactics. Table 31.10 shows trading tactics for double tops. They are similar to other double tops. Double tops serve 3 purposes. One is to get you out of a long holding. The second is to trigger a short sale. The third is to scare the daylights out of you. Before we get into a sample trade, let us review the basics. Measure rule targets. Use the measure rule to help predict how far price may decline. Determine the pattern's height and subtract it from the breakout price. The result is the target. For example, look at figure 31.6. Highest high in the Adam and Eve double top is at 28.72 on the Eve top, and the lowest low, the confirmation line, is at 25.78. Subtract the difference, 2.94, from the valley's low, 25.78, to get a target of 22.84. Price passed the target on the way down to C. The lower portion of the table shows how often price reaches targets based on various heights. The full height target, as used in the above example, reaches its target just over half the time. You may wish to cut the height in half to boost the success rate to 79%, but know you're also cutting potential profit, because the target will be closer. Once you know how far price might decline, you can check your work using Table 31.3. For example, the decline above of 2.94 in a stock trading at 25.78, the breakout price, or use the current price, is 11%. Table 31.3 says that 43% of the stocks will fail to drop more than 10%. Will a 43% failure rate persuade you to look elsewhere? Wait for breakout. As a trading signal, you will want to wait for the breakout before exiting a long position or opening a short sale. The breakout price is the lowest low between the 2 tops, shown in figure 31.6 as the confirmation line. If you sell your shares before confirmation, there is a 60% chance that price will not decline to the confirmation line but will instead move higher. I conducted a study to determine this. Once price closes below the breakout price, sell your shares or consider shorting the stock. However, the decline after many double tops isn't big, so I don't recommend going short or in many cases, selling a long holding. Trade with market trend. If you own shares in a bull market, look for underlying support and see if you can tolerate a loss to that level. With the bull market powering price upward, the downturn may be minor. In a bear market, that is the time to short a stock showing a double top. Trade with the market trend for best results. Check others in the industry. If other stocks in the same industry are showing weakness, moving down, or forming bearish chart patterns, then consider selling your stock. You might even want to sell before the breakout, but in a bull market, that may leave profits on the table when the price recovers before confirmation. In a bear market, it is a safer bet. Remember, you never go broke taking a profit. Stop location. Table 31.7 gives the probabilities of a stock reaching one of the stop locations as price seeks to find the ultimate low. Consult the table for guidance. Busted trade. Table 31.9, I said that single busted Adam and Eve double tops outperformed the non-busted double bottom. Because a busted double top is easy to spot, you might consider going long after one appears. Look for overhead resistance and underlying support to help determine if the pattern will single bust. Good luck with that. Tips. Let's pretend that I enjoy shorting stocks. Here are some tips to make your life easier. In the first series of tips, look for a strong push upward leading to the Adam top, not a trend that meanders and roller coasters for months before forming the double top. When I write of a knot, figure 31.5 shows an example of what I'm blabbering about. You'll see it at I, circled in the figure. Price moves sideways for at least 3 days with lots of price overlap. It's in the line of trend leading up to the Adam peak, and it's the closest support, not below confirmation. That's the target. Price at A almost reaches that knot and reverses. In your trade, look to the left of the Adam peak where price trends up to the double top. If the stock at confirmation is resting on a knot of support, then don't take the trade. Expect the stock to bounce off that knot and maybe bust the downward breakout. It's too high risk to short the stock. Look for the first knot of support below confirmation. The top of that knot is your price target. Price will often drop to the top of that area right after a breakout and reverse there. It's a good time and price to close out the trade. If the knot of support is well down the price trend, such as when price makes a swift rise up to the double top, the stock likely won't make it back down to the knot, at least not in the first few days. Measure the move from the knot to the confirmation price and divide by 3 or maybe half, then subtract the result from the confirmation price. That's your target. Figure 31.4 shows an example of this strong move up to the Adam peak. There's no support area, no place where price goes horizontal for 3 or more days along that run. So slice the height of the run in half or thirds and measure down that far from the confirmation price as your target. Sometimes price will bottom in an irregular fashion before the Adam peak, with several valleys touching an up-sloping trend. Connect those valleys with a trend line. That's your target. This works with a loose looking up and down movement that's quite wavy but seems to bottom along the trend line. That trend line, extended into the future, is a support area where the stock will drop and reverse. This setup is rare, but I've seen price hit the trend line and reverse there. Table 31.11 shows special features of the double top. Top-to-top variation. Does the price difference between the highest high in each top indicate better performance after the breakout? Yes. Is it a big difference? No. I found that when the price difference between the two tops was greater than the median, performance improved but only slightly as the table shows. Lower top. If the left top is lower than the right, performance improves but only marginally. The difference is probably not statistically significant. Sample trade figure 31.6 shows a sample trade in an Adam and Eve double top and serves as a tutorial for using progressive stops to protect profits. The Adam top is narrow and composed of a one-day price spike. Eve is wider and more rounded looking. When price closes below the confirmation line, the twin peaks become a valid double top. How will this pattern perform? The first thing to notice is that this double top occurs in a bull market. That suggests a smaller decline than if it were in a bear market. The S&P 500 index had just reached a new high on 7 October, but was easing lower on the breakout day, 16 October. The 5 stocks in the apparel industry that I follow all made highs in October 1997, and by the confirmation date were trending downward. That was a good indication that the stock should be sold if you owned it. The Eve peak sets the yearly high, and Table 31.4 says that the worst performance comes from breakouts within a third of the yearly high. That observation sounds a note of caution. The support line set up by the ascending triangle in June suggested that price would have a difficult time piercing it. Thus, expect a pullback. Table 31.4 shows that a pullback hurts performance, but the difference is small. Is the double top tall? The height as a percentage of the breakout price measures 11.41, just under the 11.44% value for a tall pattern. The pattern is short, suggesting underperformance. Is the pattern narrow? Yes, the pattern is 16 days wide as measured between the highest high in each top. Pattern width makes no difference for this chart pattern. Which peak is lower? The Adam peak is lower than Eve, and Table 31.11 says that there is a small performance boost 1 percentage point for that combination. This analysis showed mixed technical evidence, which is typical. If you own the stock, you could sell on the breakout. Waiting for a pullback is a risk because they occur 64% of the time, but with underlying support by the ascending triangle, a pullback was a good bet. If you wanted to short this stock, the timing is the same. Short at the breakout and add to your position if price turned downward after the pullback completed, or just short when price dropped again after the pullback. Say you short the stock at the breakout. Price pulls back, then drops to point A. Since that is a new minor low, place the stop a dime or so above the top of the pullback, the closest minor high. Price climbs to B, then drops to C. C is lower than A, so it is a new minor low. Lower the stop to B. Price climbs to D, then drops to E. Move the stop to D. Since the drop from D to E is far, you might want to cut the distance to the next stop location. Keep moving the stop lower as price drops. A new low on the way to H means the stop is lowered to F. 17% away from the low at H measured from high to low, but with this volatile stock, I would tighten the stop because price is going nearly vertical. When I see price finish 3 moves in a row where price makes a lower low and lower high like you see on the way down to H, I will move the stop to the top of the prior price bar and trail it lower. If you did that, it would cash you out the day after H. Let's assume you didn't do that. How do you sell? If the stock rises, the stop will take you out automatically. Another way is to see the head and shoulders bottom forming at GHK. A neckline drawn from F to J and extended to the right marks the breakout price for that chart pattern. Cover your short at the open the day after price closes above the neckline. If you traded this stock, you would have made about 16%. That value matches the average decline for double tops, see Table 31.2. 32. Double tops, Eve and Adam. Results snapshot. Appearance. Price climbs to twin peaks that top out at about the same price. The left peak looks wide and rounded, but the right peak is narrow and sharp, an inverted V shape. Price drops after the right peak. The results snapshot shows the important statistics for the Eve and Adam double top. This pattern is rare. It has just a few more samples than the rarest of the 4 combinations of Adam and Eve double tops. The average decline, 15%, meets the value of all chart patterns, 15%, giving it a performance rank of 16 out of 36 where one is best. That's just above the halfway mark. Failures have a rank of 14 out of 36, not shown. The volume trend is random, really, with 51% trending upward. Pullbacks occur with the same frequency that we see in other chart patterns, happening in almost 2 out of 3 cases. Price meets the measure rule target just over half the time, suggesting price doesn't drop as far as one might expect or hope. Let's take a quick tour. Figure 32.1 shows what a double top looks like. The Eve top is wide and rounded looking compared to the Adam top, which appears narrow, like an inverted V, usually with a long 1 or 2 day price spike. The pattern forms after an upward price trend and does not become a true double top until price closes below the confirmation line. Only then should a trader take a position in the stock or sell an existing holding. This figure also shows good examples of gaps, breakaway, continuation, and exhaustion. The first of the trio appears just before confirmation and leads to the ultimate low in September. Another pair begins in December with a breakaway gap overlapping the earlier continuation gap and creating a price island from September to December. An exhaustion gap signals the end of the fast, uphill run. After that, price still climbs but at a more sedate pace. Identification guidelines. How do you distinguish an Eve and Adam double top from any ordinary twin peak pattern? Look at Figure 32.2 and Table 32.1 for the answer. The figure shows two Eve and Adam double tops. Appearance. Look for two peaks. The left one, Eve, should be wider and more rounded looking than the right one, Adam. Adam is narrow, usually an inverted V shape and many times with a 1 or 2 day price spike. Above all else, the two tops should look different from each other. In the figure, the difference between the shapes of the two peaks in each case is clear. To help gauge the width, look farther down the top, toward the base of the chart pattern. Adam peaks usually remain narrow, but Eve is wide. For example, the May double top at a price of 29 shows Adam as a 1 day price spike, but Eve is much wider. Price trend. Create a top, price must be trending upward, even if the trend is short. For reference, the median price trend leading to the double top in the stocks I looked at was 123 days, or about 4 months long. Valley between tops. Look for a price dip between the two tops. Some will say 10% is the minimum, but I did not use a limitation. The median drop I found in my patterns was 9%. Dip separates the two tops, so they are not part of the same consolidation region. Top high price. The highest high on the left peak should be close to the price of the right one. Often the differences are small, median of 1%. Many times I'll select patterns with peaks obviously not at the same price as long as they appear in the spirit of a twin peak pattern. Top separation. The median top separation was 22 days, measured from the highest high in each peak. What you want to see are two minor highs, well separated and defined. Price decline after right top. Price must close below the confirmation price without first forming a third peak. If a third peak appears before confirmation, then trade the pattern as a triple top, but check that it confirms as a valid chart pattern. Volume. Of the 4 types of Adam and Eve double tops, this is the only one to have volume heavier on the right top. However, it's nearly random with 51% showing volume higher on the right peak. Breakout direction, confirmation. Price breaks out downward from the pattern by definition. If price closes above the top of the highest peak in the pattern, then it's not a double top. When price breaks out downward, it confirms the pattern as valid. Focus on failures. Why do double tops fail? There are many reasons, including a general market that reverses trend. Since a rising tide lifts all boats, your stock may climb with the bull market or falter if the company is struggling. If other stocks in the industry are doing well, that activity will tend to support the stock. Fundamental factors, such as good retail sales, an exceptionally good quarter, insider buying, a stock buyback program, or positive comments about the future made by management will all help boost the stock price. However, the one key element I find time after time is an impenetrable support zone below the chart pattern. Figure 32.3 shows an example. A support zone forms as far back as January 1997 at about 12.50. I show a portion of the zone's top at the support line. The support line can act as both support and resistance, depending on which way price approaches the line. Peaks in October through November and congestion at B add to the massive support. The support was enough to turn back price at A and stall the downtrend at C. I would expect price to pause there on the way up, too, which it did several times, as late as 2007, a decade after the zone started. Statistics. Table 32.2 shows general statistics. Number found. I uncovered 777 double tops in 513 stocks starting from July 1991 to March 2020. Not all stocks covered the entire period, and some no longer trade. Bear market patterns numbered 115, too few to make the cut in this edition. I sent them back down to the minor leagues. Reversal R, continuation C occurrence. By definition, a double top acts as a reversal of the upward price trend. Average decline. The average decline is well average. It's half a percentage point, 15.4% above the average for all chart patterns, 14.9%. Standard and Poor's 500 change. In bull markets, the S&P index dropped 4%, helping stocks drop. I measured the drop from the date of breakout to the ultimate low of the double top and applied those dates to the index and then checked performance. Notice how the average decline is significantly higher than that shown by the index. Days to ultimate low. It takes just about 7 weeks for price to reach the ultimate low. How many change trend? A trend change is a drop of more than 20%. Eve and Adam chart patterns fall short of the average, 28%, for all bearish chart patterns. In other words, 27% of double tops will see price drop more than 20% after the breakout. The higher the number shown in the table, the better I like the pattern. Table 32.3 shows failure rates. How do you read this table? Let me give you a few examples. Suppose your total cost of trading is 5%. How many patterns will fail to drop more than that? Answer: 21% in bull markets. If you want to make an additional 10% above your cost, a total of 15%, how many double tops will fail see price drop more than 15%? Answer: 61%. That's a huge failure rate for such a small drop. In the trading tactics section, we'll discuss the measure rule. Suppose it projects a decline from 10 to 8, or 20% in an Eve and Adam pattern you wish to trade. How many double tops will see price decline 20% in bull markets? Answer: 27%. 73% will fail to decline more than 20%. Thus, the target of 8 seems like a dream, so make the target more conservative by picking one closer to 10. Table 32.4 shows breakout-related statistics. Breakout direction. As I mentioned earlier, the breakout is downward from a double top by definition. A breakout happens when price closes below the lowest valley between the two peaks. Yearly position performance. What position in the yearly high-low trading range performs best? Those double tops with breakouts within a third of the yearly low outperform the other two-thirds. You'll want to avoid trading double tops with breakouts near the yearly high. Or to put it another way, if you own a stock making new highs and you see a double top, don't freak out. Decline may be less than you expect, and the pattern may not confirm anyway. However, you may run across the outlier and have your wallet or purse ripped out of your hands, so do your diligence checks. Pullbacks. Almost 2 out of 3, 64%, Eve and Adam double tops pull back to the breakout price and take an average of 12 days to complete the trip. When price does pull back, the upward retrace breaks downward momentum and performance suffers. At least that's the story I'm telling everyone. After a pullback completes, price returns, trending downward just over half the time. Before trading, look for underlying support. If a support zone is nearby, then bet on a pullback happening. Gaps. Gaps hurt performance, as Table 32.4 shows. The performance difference is minimal, though. Table 32.5 shows pattern size statistics. Height. Tall patterns perform better than short ones. I measured height from the higher of the two peaks to the confirmation price, then divided by the confirmation price. Results higher than the median shown in the table mean the pattern was tall. Width. I looked at pattern width, measuring between the highest high in each peak and compared that to the median length. Wide patterns outperformed narrow ones, height and width combinations. Patterns both tall and wide performed best. Avoid those that are short, either wide or narrow. Table 32.6 shows volume-related statistics. Volume trend. The volume trend is upward, but only 51% of the time. That's near random. Rising and falling volume, breakout day volume. The next 4 rows show how volume may indicate better or worse performance. Rising or falling volume doesn't affect performance, and heavy breakout day volume does help, but don't wake mom to tell her. She needs her rest. Table 32.7 shows how often price reaches a stop location. I split the pattern in half and found that if I placed a stop at the top of the pattern, the order would trigger only 4% of the time. Place the stop-loss order at a different location, and the hit rate changes. Top of the pattern may be too far away, so a potential loss may be expensive. Do check to be sure you can tolerate the potential loss without yelling too loudly. Table 32.8 shows performance over 3 decades, performance over time. The 1990s were the star decade for performance. The other 2 decades tied for second place, failures over time. The numbers are as I expected. Failures have increased in each decade since the 1990s. The trend doesn't bode well for the 2020s, but at least the trend is consistent. Table 32.9 shows busted pattern performance. As you may know, a bust occurs when price breaks out downward, drops no more than 10%, before reversing and closing above the taller of the 2 peaks in the double top. Busted patterns count. Almost half of Eve and Adam double tops will bust. That's alarming if you like to sell short. Busted occurrence. I sorted each busted pattern into single, double, and 3 or more busts. Single busted patterns occur in almost 2 of every 3 busted patterns. Busted and non-busted performance. I used Eve and Adam double bottoms as the proxy for non-busted patterns. Single busted double tops beat the non-busted double bottoms, and also the combined performance of single, double, and 3 or more busts, triple plus. What are the galactic implications of this? Trade a single busted double top if you can find one. How can you tell if a double top will bust once only? I haven't figured that out yet. Trading tactics. Table 32.10 shows trading tactics for double tops. They are similar to other double tops. Measure rule targets. Use the measure rule to help predict a target price to which your stock may descend after the breakout. For example, in figure 32.5, the atom peak is the higher of the two, and it tops out at 34.90. The confirmation price is the lowest low between the two peaks, and it is at 31.70. The difference is 3.20. Subtract the height from the confirmation price to get a target of. Wait a minute, let me find my calculator. It's solar powered and I'm using it at night, so maybe you should double check the result. Answer: 28.50. Although the measure rule works for the stock shown in figure 32.5, it only works 55% of the time for Eve and Atom double tops. The bottom portion of the table shows the target hit rate for various heights. You might want to run the potential drop by table 32.3 and see what it says. In this case, a 3.20 drop in a stock with a breakout price of 31.70 is a drop of 10%. Table 32.3 says that almost half, 47% of patterns will not drop more than 10% after the breakout. It also means 53% will reach the target. Whether you decide to trade the potential drop is up to you. Wait for breakout. Most of the time, you will want to wait for price to confirm the pattern by closing below the confirmation price. If you do not wait, there is a 60% chance I researched this that price will climb instead of confirming. However, there are exceptions to the wait for breakout rule. For example, if you see an especially dire situation developing in a stock you own, then protect your profits and sell early. If the market or industry is dropping and there was a quick rise leading to the pattern, then consider selling early. A quick decline sometimes follows a quick rise, but it's rarer than you might expect. Other technical indicators may suggest a sale, so check those too. Trade with market trend. Avoid shorting a stock in a raging bull market unless the situation warrants. In bull markets, it may make sense to hold onto a stock and weather the downturn. Look for underlying support that would stop a decline. Usually, when the bull market is pushing price skyward, it is a mistake to sell when seeing a double top. Chances are that, in a few weeks or months, the stock's price will be higher. Swing traders and short-term traders, however, will want to sell as soon as the pattern confirms to lock in a long side profit, then look elsewhere for another trading opportunity. Check others in the industry. Look at how the general market and other stocks in the same industry are behaving. That activity is often key to how your stock will perform. If other stocks in the industry are falling or showing signs of topping out, chances are your stock will decline too. If so, it is best to sell a long holding or consider shorting the stock. Stop location. Table 32.7 shows guidance for stop placement, so look at the numbers and read the brief description. Be sure to change the potential loss into a percentage and check table 32.3 to see how often price declines that far after a double top breakout. Busted trade. If you want the potential to make big bucks, trade a busted Eve and Atom double top. Busted double tops beat Eve and Atom double bottoms in performance. See table 32.9 for highlights. This just in, table 32.11 shows special features of the double top. Top-to-top variation. I looked at the price variation between the highest high in each peak. When the difference was larger than the median 1%, the double top tended to outperform after the breakout. This trend is also true for the other Atom and Eve variations. Lower top. Do patterns with a lower right peak perform better? No, but the performance difference when the left top is lower is minimal. Experience. Figure 32.4 shows an actual trade I made in Bed Bath & Beyond, BBBY, starting in the summer of 1996. My buy reason is long and complicated, so I won't discuss it much. However, maybe you can make sense of it or find it useful as a bedtime story. 22 July 1996. I purchased at 5.81 today at the market. Yesterday, I was reviewing my Trend Channel Trades notebook and noticed that MACD forewarned me not to purchase Varco the first time and to wait on HMSY. This indicator parallels the OBV and Bollinger Band indicators, so I compared its signal with BBBY and it said buy. OBV and Bollinger Band said purchase was okay too. It just bounced off the trend channel bottom 3 days ago after hovering there for a while. Although I am late off the channel bottom in buying the stock, I trust it will continue rising. I did not buy earlier because general market conditions were horrible general downturn, and I believed that the stock would continue down. When it turned around, I bought. VL ranks the stock 1-3 with a technical rank of 1 as of 28 June, almost a month ago. With its 30% annual growth rate in new stores and other fundamental factors, this stock could be a good holding for the long haul. If they can continue store growth with internally generated cash flow, this will be a good stock to own. After placing the order last night, I had second thoughts. I think the stock will fall back to its consolidation range, $4.75 to 5.00. It makes me nervous to buy after the stock has climbed so quickly. Will intuition be right, or will the mind prevail? In any case, although I have been watching this stock as a buy candidate for a few weeks now, I was uneasy with the rapidity that I bought this one. Once I noticed that MACD said it was a buy, I checked a few things, then placed the order. Much too quick and not thorough enough. I don't know where the trend channel was, but the notebook entry made mention of the channel 3 days before I bought, which I show as B. I bought at a, well above the low at B. On October 6, I made mention of a small cup with handle pattern. I show that as CD cup with handle E. Yes, the cup bottom isn't rounded at all. It's more like an ugly double bottom as part of a big W, a pattern with a higher second bottom, the ugly part, and one with tall sides, the big W. Let's advance the timeline to 4 October 1997, a year later. I placed an order to sell half my holdings at the market tomorrow. Why? A budding double top formation. I know that you should wait for confirmation, but the decline to 7.63 from the current 8.75 is just too far to wait. If it continues to rise, fundamentally speaking, the prospects are bright. Then I still have half my holdings. If it declines to the formation base at 7.63 or continues on down for another 18% average for a reversal, then I'll have the opportunity to buy more. Also, the top at 9.06 is slightly higher than the prior top, 9.03, which is slightly more likely for a double top. I show the sale at H. The budding double top is at F and G. My spreadsheet of the trade calls this an Eve and Adam double top, but is it really? My computer will tell you it's an Eve and Eve, and I think it's an Adam and Eve. That's the problem with Adam and Eve designations. It's too subjective. Anyway, I made 52% on the trade. The stock reached the ultimate low at I, at 7.20 or 19% below where I sold at 8.88. Then the stock recovered and peaked at 14.48 in June 1998. Lesson: if you think a double top is forming, consider selling near the second peak. If you're right, it could save you money as price drops to confirmation. However, price won't confirm a double top 60% of the time, meaning price will rise instead of drop. In this trade, selling half of my holding worked well. On the second half of the trade, I made 153%. Sample trade. Figure 32.5 shows a sample trade for an Eve and Adam double top. As you look at the figure, it may strike you that the double top takes place in a downward price trend, beginning with the high on the left side of the chart and sliding to the low at the right. It reminds me of a measured move-down chart pattern. Does the pattern obey the guidelines listed in Table 32.1? The brief rise shown by line satisfies the upward price trend leading to the double top. Twin peak pattern shows a rounded Eve top paired with a pointed Adam top. The valley between the tops measures 9%, a bit on the short side, but who's counting? The two tops have prices that vary by just 1% and are 25 days apart. Price drops to the confirmation line without making a third peak. Volume is heavier on the left peak than the right, which is unusual, but that's okay. Thus, the pattern meets the identification guidelines. It is a valid Eve and Adam double top. What is so special about this double top? Two things. First, the U-shaped volume pattern is exquisite. Second, notice the quick rise leading to the pattern, highlighted by line A. Price rockets upward for a week, then moves sideways in the double top. Nearly as steep is the decline out of the pattern, shown by line B. If I were trading this double top, I would place an order to sell shares at the confirmation line. That way, I would get in at a good price as the pattern confirmed. I would expect a pullback because of the July congestion shown in the first third of the long trend line ending at C. Worst case, I would put a stop at the Adam top, just in case things got out of control. For the downward target, the measure rule predicts a decline to 28.50, as I discussed in the measure rule in Table 32.10. Since I know that a quick decline can follow a quick rise, I would set the target lower, at the beginning of the quick rise, or about 27.78. Since that is below the round number 28, I would probably target 28.07 or some oddball number above that support. Everyone is going to try buying at 28, and I want to get my price before the others drive it back up. In fact, you can see that price stalled at 28 for 3 days before resuming the tumble point D in figure 32.5. If by some magic I stayed in the trade, I would expect a further decline to the down-sloping trend line. A rising volume trend as price declined is a good sign of a strong down move. The quick rise after C suggests you need to be on top of this stock, following it closely to time the exit if you do not use a stop order. Delays are costly. 33. Double tops eve and eve. Results snapshot. Appearance. 2 peaks appear at about the same price level. Both peaks have wide, rounded-looking turns. When traders say double top, they are most likely referring to an eve and eve double top. This is the classic double top, but performance places it behind the Adam and Eve double top. The above performance rank, 12 out of 36 where one is best, shows the chart pattern is near the top tier among the family of chart patterns. The break-even failure rate is better than the average of 24.7% for types of all chart pattern, but it ranks 11 there, not shown. Volume trends downward 59% of the time and pullbacks happen about 2 of every 3 trades. Let me share some family photos with you of the pattern. Tour. Figure 33.1 shows what an eve and eve double top looks like. It reminds me of a person with large eyebrows. The confirmation line points to the nose, and the mouth is the U-shaped volume pattern. In the second edition, I discussed volume shapes, but decided in the third edition that volume shape was too subjective. If the pattern was long, it could have several volume shapes involved. That confused the issue. Volume shape was an interesting idea that didn't add trading value, so I removed it. Now I'm wondering if the shape of price between the 2 peaks adds value. I'll consider exploring that another time, but look for price to form a valley between the peaks, making the 2 peaks stand out. Twin peaks look similar in that both have wide bases and a gentle, but not necessarily smooth, price turn at each top. Contrast the 2 eve peaks with the 2 Adam peaks in March and April. Those peaks are narrow, and a one-day price spike soars above the surrounding landscape. If price spikes appear in an eve top, they are often more numerous and short, although not in figure 33.1. A better version of the Adam shape is the 2 lowest valleys on the chart, October and March. Yes, they are bottoms but narrow, V-shaped turns. Flip them upside down and they would make terrific Adam tops. What should a trader look for when selecting reliable low failure rate and high price performance twin peak patterns? Identification guidelines. Table 33.1 shows identification guidelines for eve and eve double tops. Refer to figure 33.2 for an example. Appearance. The 2 tops should look similar to each other. That is, the wide and rounded September peak should not look like the narrow price spike of the Adam peak in April. Although the August eve peak has a twin spike, the top is wide enough to mirror the September peak, so I classify it as an eve top too. Adam tops look more like the peak that pullback points to in the figure. The width does not widen much as you scan down the pattern. Both eve peaks are considerably wider than the Adam pullback one. Price trend. Since we are dealing with tops, price must trend upward leading to the start of the pattern and leave the pattern heading downward. The upward price trend leading to the double top need not be long. Figure 33.2 shows a steep 48-day uptrend from the late June low. Valley between tops. The valley between the tops varies in depth. The figure shows a dip of 14%, measured from the highest high to the lowest low in the pattern. The depth measure is just a guideline, not a rule, so allow variations. I will say that dips larger than the median perform slightly better by 2 percentage points. Top high price. The peaks should top out near the same high price. The usual price difference between the 2 peaks is tiny, 1% median. The peaks should not look like stair steps, but like 2 tops hitting overhead resistance near the same price. Figure 33.2 shows tops with almost no 0.29% price difference. In patterns I look at for my trading, I'm not that concerned with whether the 2 peaks align in price. As long as they appear eve-shaped and look like a topping pattern, then I'm fine with it. Top separation. Look for 2 well-separated peaks, not twin bumps that are part of the same congestion pattern. The double top in the figure, for example, shows peaks 33 days apart, measured between the 2 highest price bars. And that's typical. Price decline after right top. Price must close below the confirmation line to validate the double top pattern. If a double top forms a third peak before price closes below the confirmation line, then consider it a triple top and trade it as such. Volume. Volume varies but is usually heavier on the left top than on the right. However, do not exclude a potential double top just because volume is heavier on the right peak than the left. Breakout direction. When price closes below the lowest valley between the two peaks, it stages a downward breakout. If price closes above the top of the pattern first, then it's not a double top. When price breaks out downward, it confirms the pattern as a true double top. Investing without waiting for confirmation is usually an amateur's game, one that ends in a loss or missed profits. Why do I say that? A study of twin peak patterns found that 60% climbed away from the pattern instead of dropping down to the confirmation line. Potential double top remain just squiggles on the price chart and not a valid double top pattern. Figure 33.3 shows another example of an eve and eve double top. The right peak looks like two atom tops, but the peak separation is not wide enough to call the three peaks a triple top. The landscape looks like two hills with the right hill having a few tall trees, but still forming one hill. Running through the identification guidelines, we see that price trends upward to the first top. The two tops look rounded, and the valley between them separates the peaks into two individual hills. The price variation between the two tops is considered large for statistical purposes, measuring 3%, but the tops look like they stop near the same price. Volume is heavier on the right peak than the left, using 2 days before to 2 days after the highest high in each peak, which is unusual. Price confirms the pattern in April when it closes below the confirmation line. Within a month, price pulls back to the confirmation line before resuming the downtrend. Focus on failures. What does an eve and eve double top failure look like, and can anything be learned from it? Consider figure 33.4, a common failure of a double top. The twin peaks satisfy all of the identification guidelines outlined in table 33.1 with two exceptions. First, the volume pattern is suspect. Volume on creation of the left top is high but lasts only 1 day. The right top volume is dense, high, and remains high for about a week as the top forms. However, in defense of the double top, the volume pattern often varies from the norm and offers little clue to the eventual outcome. In other words, the volume pattern doesn't offer much help in deciding if this pattern will succeed or fail. The second guideline violated is the more important of the two. Price fails to close below the confirmation point. As I mentioned, this type of failure to achieve confirmation happens 60% of the time. Expect top reversals, such as the double top, to perform poorly in bull markets, whereas bullish bottom reversals should excel. That appears to be the case with many of the chart patterns covered in this book. Another type of failure not shown in the figure is what I call a 5% failure. Price fails to drop more than 5% after the breakout. 1 in 5 20% double tops will suffer a 5% failure. Compared to other chart pattern types, that's relatively low, but 20% isn't exactly zero. Speaking of numbers, let's talk about them. Statistics. Table 33.2 shows general statistics. Number found. I found 1196 double tops in 692 stocks starting from July 1991 to February 2020. Not all stocks covered the entire span, and some no longer trade. There were too few double tops appearing in bear markets, so I decided not to cover them in this edition. That's why the table shows fewer found. The statistics only apply to bull markets. Reversal R, continuation C occurrence. By definition, double tops act as reversals of the prevailing price trend. Price rises into the pattern and leaves heading back down. Average decline. The average decline for all chart pattern types is 14.9%, so the eve and eve double top does a bit better than that. Standard and Poor's 500 change. The index declined, and I believe it helped the double top show better performance. You can also look at this as how well the index did compared to the double top. Both use the same dates from the double top, breakout to ultimate low. The double top performed 4 times as well as the index, on average, days to ultimate low. It took about 2 months for price to reach the ultimate low after the breakout. You may wish to compare the 16% drop in 2 months with other investments to see if they perform as well. However, these numbers are for perfect trades and are an average, so your mileage may vary. How many change trend? This is my attempt to create a gauge for how trendy a pattern is. I counted how often price fell more than 20% from the breakout. That's not a good definition of trendy, however. Even so, Eve and Eve ranks 12 out of 36 where 1 is best, so this chart pattern performs well. Table 33.3 shows failure rates for double tops. You read a row like this, I found that 20% of the double tops failed to see price drop by more than 5%. A decline of 10% sees the failure rate double to 40%. Yikes, it almost triples the 5% failure rate in the next row down in the table, where 58% fail to see price drop more than 15%. Table 33.4 shows breakout-related statistics. Breakout direction. In confirmed double tops, the breakout direction is always downward. Yearly position performance. Patterns with breakouts within a third of the yearly high perform worst, but the numbers are close enough that the differences are not meaningful, probably not statistically significant. Pullbacks. A pullback takes 12 days on average for the stock to return to the breakout price. When a pullback happens, performance suffers as the table shows. Look for underlying support and avoid double tops with support close enough to cause a pullback. How close is close? The median drop during a pullback is 6%, so use that as a gauge to look for nearby support, that far down. After a pullback completes, price resumes the downtrend just over half the time. That also means price reaches the ultimate low during a pullback 45% of the time and price rises thereafter. Gaps. Whether a gap occurs or doesn't occur, I didn't see any performance difference. Table 33.5 shows pattern size statistics. Height. Double tops continue a tradition of seeing tall patterns performing better than short ones. To use this finding, measure the height from the higher of the two peaks to the confirmation line and divide by the breakout price the value of the confirmation line. If the result is higher than the median shown in the table, then you have a tall pattern. Trade only tall patterns for the best average performance. Width. Width does not show any performance advantage for double tops. However, in many other chart pattern types, wide patterns usually 85% of the time show better performance. Height and width combinations. I looked at the height and width combinations and found that the best performing patterns were tall and narrow ones. Tall and wide patterns place a close second. The worst performance came from double tops that were short and wide. Avoid those by comparing the double top you plan to trade with the median measures shown in the table. Table 33.6 shows volume-related statistics, and I don't see much to be excited about. Volume trend. Volume trends downward 59% of the time. I found this using linear regression as measured from peak to peak. Rising/falling volume. Double tops that see price rise from the left peak to the right have a slight performance edge. It's not an earth-shaking difference, but it is an edge. Breakout day volume. I saw no performance difference between heavy or light breakout volume, but many technical traders will say that heavy breakout day volume is best. A scan of other chart patterns shows that heavy breakout volume does help performance most of the time. I discussed this in the first chapter. Table 33.7 shows how often price reaches a stop location. If you place a stop-loss order at the higher of the two peaks, you'll be stopped out 1% of the time on average if you trade it often enough, and if your stocks perform like the nearly 1,000 patterns I examined for Eve and Eve double tops. Other locations show higher stop-out rates. Once you determine where the stop should go, then divide the potential loss by the current price as a percentage and see if you can tolerate such a loss. If not, then move your stop closer, increasing the stop-out risk, or just look for another chart pattern to trade. You don't have to trade the one you're looking at. In fact, if you fall in love with or hate the stock, it's probably a signal you're making a mistake, you're letting emotions rule. Table 33.8 shows double top performance over 3 decades. The two bear markets in the 2000s were not included in the statistics. Performance over time. The 1990s were the best performing decade for Eve and Eve, but the other 2 decades are close behind. Failures over time. Failures have steadily increased over the decades. It makes you wonder what the 2020s will bring. Table 33.9 shows busted pattern performance. Busted patterns count. Only about a third of the double tops will bust. That's quite good for a bearish pattern. Busted occurrence. Single busted patterns, which we'll see as outstanding performers next, happen 2/3 of the time from those patterns which bust. Placing second are 3 or more busts, triple plus, not double busts. That's not unusual though. Busted and non-busted performance. I used Eve and Eve double bottoms as the proxy for a double top with an upward breakout, which doesn't exist by definition. Single busted patterns outperform the double bottom and the all busted combination of single, double, and triple plus busts. What does this mean? You could trade an Eve and Eve double top in the normal manner and average 16% if you trade it often enough and perfectly, from table 33.2. Or you can trade a busted double top, and if it's single busts, you can make an average of 54%. There are a lot of ifs involved in this, including trading the stock perfectly and trading only patterns which single bust. I'd rather have a chance of making 54% than 16%. Trading tactics. Table 33.10 shows trading tactics, but you'll discover they are similar to other double top patterns. Measure rule. Use the measure rule to help gauge how far price will decline after the breakout. Take the difference between the highest high in the pattern, the higher of the two peaks, and the valley low between the two peaks. Subtract the height from the confirmation price to get the target. For example, the double top shown in figure 33.5 has the highest high on the left peak at 32.45. The lowest low is at the breakout, 28, for a height of 4.45. Subtract the result from the lowest low to find the target of 23.55. Price fails to reach the target as the stock drops to B. How often does the measure rule work? Glad you asked, because I provide the answer in the lower portion of the table. Using the full height, as in the example above, price reaches the target just 43% of the time. Maybe that explains why the stock in the figure didn't drop that far. If you cut the height in half and use that in the computation, you'll see that the stock reached the closer target, 25.77, on the way to B. For another check, convert the target distance into a percentage of the current price. In this example, that's 16%. Table 33.3 says that 58% of the stock will fail to see price drop more than 15%. That means 42% will work as you hope, and that's not a good probability in my opinion. Wait for breakout. Since 60% of twin peak patterns never confirm, price trends higher. You should wait for the breakout before selling a long holding or shorting a stock. The exception to this rule is if you have a compelling situation that demands a quick exit. For example, if price just completed the turn at the second top and the company issues an earnings warning, sending the stock tumbling, then consider selling immediately. Chances are that the next quarter will also be bad, but this depends on why earnings are soft. Some problems are easily fixed while others are not. Trade with market trend. Eve and Eve double tops are bearish chart patterns, so it makes sense to trade them in bear markets, not in bull markets. If you own stock in a bull market and it double tops, can you weather the downturn? If the general market is soft when your stock double tops, maybe it is time to sell. I ignore double tops because the decline is usually not severe enough to be worth paying capital gains taxes to the government. That's often the case in a raging bull market. You'll see a double top that will take price down, but not far, only to see the stock recover quickly and soar to new highs. But it's your money, and selling near the top is better than selling near the bottom. Check others in the industry. If other stocks in the same industry are hurting along with yours, then sell your stock or consider shorting. This advice is especially useful if the general market is tumbling too. Wait for trend change. Such a large price rise after the ultimate low or from a busted pattern, consider buying then. The sample trade gives an example. Stop location. Table 33.7 shows various stop locations for double tops. Be sure to convert the potential loss into a percentage of the current price. If the value is too large, many use 8% as a maximum loss value, then either adjust the stop or abandon the trade. Busted trade. Table 33.9 discusses trading single busted patterns. I think that's probably the best way to trade a double top. Unfortunately, it relies on a single busted pattern, and there's no guarantee that the stock will bust only once. Thus, it's a risk, but the reward can fill your wallet or purse if you trade the pattern often enough and well enough. Tips. Tips I discussed in the chapter on Adam and Eve double tops apply to its twin Eve. Let's talk about them. In the first series of tips listed below, look for a strong push upward leading to the first top, not a trend that meanders and roller coasters for months before forming the peak. When I write of a knot, figure 31.5, not figure 33.5, shows an example of what I'm blabbering about. You'll see it at I, circled in the figure. Price moves sideways for at least 3 days with lots of price overlap. It's in the line of trend leading up to the Adam peak, and it's the closest support not below confirmation. That's the target. Price at A almost reaches that knot and reverses. In your stock, look to the left where price trends up to the double top. If the stock at confirmation is resting on a knot of support, then don't take the trade. Expect the stock to bounce off that knot and maybe bust the downward breakout. It's too high risk to short the stock. Look for the first knot of support below confirmation. The top of that knot is your price target. Price will often drop to the top of the knot right after a breakout and reverse there. It's a good time and price to close out the trade. If the knot of support is well down the price trend, such as when price makes a steep but long rise up to the double top, the stock likely won't make it back down to the knot, at least not in the first few days. Measure the move from the knot to the confirmation price and divide by 3 or maybe half and subtract it from the confirmation price. That's your target. Figure 31.4 shows an example of this strong move up to the atom peak. There's no support area, no place where price goes horizontal for 3 or more days along that run. So slice the height of the run in half or thirds and measure down that far from the confirmation price as your target. Sometimes price will bottom in an irregular fashion before the first eve peak, with several valleys touching an up-sloping trend. Connect those valleys with a trend line. That's your target. This works with a loose looking up and down movement that's quite wavy but seems to bottom along the trend line. That trend line, extended into the future, is a support area where the stock will drop and reverse. This setup is rare, but I've seen price hit the trend line and reverse there. Table 33.11 shows special features for double tops, top-to-top variation. Patterns in bull markets show better performance when the price variation between the highest high in each top is larger than the 1% median. The difference between the two is large enough that you might want to pay attention to this idea. Lower top. I didn't see any performance improvement in this measure. I checked to see if performance changed depending on which top of the double top was lower. Sample trade. Figure 33.5 shows the sample trade for eve and eve double tops. In a bull market, after a double top, price soars 60% after reaching the ultimate low, as I've mentioned. Even if you are late calling the turn, you can still make a profit. Consider the eve and eve double top shown in the figure. Before you trade this stock, ask yourself if it is an eve and eve double top. Running through the identification guidelines shown in Table 33.1, we find that the price rise leading to the pattern begins at A, far left bottom. Both peaks look similar in that they are wide and made of several short spikes, all characteristic of eve tops. The left peak is more pointed but wider than the right one, but they look like two rounded hills on the price landscape. The valley between the two peaks dips 14%, and the peaks top out at about the same price. The peak-to-peak separation measures 55 days or almost 2 months. Volume is heavier on the right peak than the left. Finally, the decline to the confirmation line is a straight line run. Price does not form a third peak. In short, this is a valid double top when price closes below the confirmation line. How do you trade it? For this trade, imagine that you do not own the stock, nor do you want to sell it short. The S&P 500 index reached a low in October 2002 and bounced, forming a higher low in early March, right when price was bottoming at B. Other stocks in the retail store industry were bottoming at the same time or were completing a bottom retest, a higher low. What was clear after the March bottom was that everything started moving up in tandem. The industry started recovering, as did the general market, a new bull run. A buy signal occurred when price closed above the down-sloping trend line. The high volume at B, a common bottom phenomenon, also suggested a bottom, panic selling. Additional evidence of a major turn comes from points A and B. Point A marks a major turning point for the stock. B, being a higher low, is a retest of that low. Since B did not drop below A, it is a bullish signal. If you missed the trendline signal and higher low at B, then a close above the double top would be another buy signal. With a 54% average rise for a single busted double top, you have plenty of time to buy. If you bought at the B low, you would have made 73%. Buying at the double top high would have made a profit of 36%. Stock topped out at 44.13, by the way, before tumbling back to 32, near the double top high. Not all trades will work out as well as this one, and your timing has to be exquisite. A major bull run began after the October low, and the industry responded with large gains. Both helped propel the stock higher. A combination of bullish factors is often what separates a winning trade from a losing one. 34. Flags. Results snapshot. Appearance. looks like a short rectangle bounded by two parallel or nearly parallel trend lines in a strong price trend, the flagpole. Small flags appear like roadkill along the price highway. You find them in a fast-moving price trend flagpole, one that zips along for just a few days. Price pauses at the flag and then continues in the same direction as before encountering the flag many times. That behavior is not always the case, of course, as price reversals abound, so you should wait for the breakout to be sure. The result snapshot shows the performance statistics. However, I don't rank this pattern for performance because I don't measure the move to the ultimate high or low like I do with traditional chart patterns. I measure the move to the trend end, the nearest minor high or low. The break-even failure rates are large and get worse fast, but that's expected. I'll explain that in the statistics section. The failure rates are not as important as how often price meets the measure rule target. In theory, flags work as half-staff patterns, meaning they appear midway in the price trend. The snapshot says that works around half the time. A more accurate measure, using two pattern configurations, says the flag appears later in the price trend than midway, except for one case, see Table 34.12. Tour. Figure 34.1 shows a good example of a flag in a short-term downward price trend. The flag is bounded by two parallel trend lines and is no more than 3 weeks long, often as short as a few days. You'll see flags appearing in strong uptrends or downtrends, such as that shown in the figure, sometimes near the halfway point of the move. This particular flag goes against the grain in the sense that price retraces the downtrend. This is the most common behavior, a retrace against the prevailing price trend, but it is not unusual for flags to appear horizontal as short rectangles or slope downward following the trend. Since flags can also appear in uptrends, they usually retrace downward but can be horizontal or tilt upward too. Identification guidelines. Figure 34.2 shows two flags, the first one in a downward price trend and the second after price turns at the bottom. For both flags, the quick price move starts at their respective point AS and finishes at their respective point BTS. In these two examples, the move after the flag is longer than the one before the flag, but that is usually not the case. The move after the flag completes is a key trait of this pattern. By using the length of the trend leading to the flag, you can gauge how far price will move after the breakout. Table 34.1 outlines the identification characteristics for flags. Appearance. Two parallel trend lines bound the price action for flags, as shown in Figure 34.3. However, the flagpole is an important part of the pattern. If you don't have a flagpole, then I consider the flag invalid. You may decide otherwise. You may enjoy shooting yourself in the foot too. Figure 34.2, for example, has a nice flagpole in the right March flag starting at A. Price rises smartly in a brisk upward move. The left flag August I would probably discard because the one-day price drop leading to the start of the flag isn't long enough. Even so, the flag pattern is pretty, with a nice tight-looking upward retrace. Price trend flagpole. Reliable flags appear during steep price trends, forming a flagpole. Trends might be up or down, but price rises or falls quickly, moving several points depending on the price of the stock. It could be cents, not dollars, in just a few days to a few weeks. In Figure 34.3, for example, the flagpole begins on 18 January and the flag begins on 1 February. In that short time, price tumbles from a high of 40.75 to a low of 30.13. Notice how the price trend in the flag slopes upward. This behavior is typical for the prevailing price trend, that is, flags typically form against the trend but not always. Volume. The volume trend nearly always recedes over the flag portion of the pattern. However, this is not an inviolate rule, but usually is the case. Don't discard a flag because it has an unusual volume trend. Breakout direction. Price can break out in any direction but expect it to follow the prevailing trend. I'll discuss the breakout direction in Table 34.4. Duration. Flags are short compared to many other chart patterns. In the case of Figure 34.3, the flag is 12 trading days long. Many times when a flag is very short, such as 3 or 4 days, it appears as a horizontal rectangle, a dark blob in the middle of a fast price trend. You may want to clean your eyewear in case it's a spot on the glass. I limited the length of flags in my study to 3 weeks, but that is an arbitrary limit. When selecting a flag to trade, the most important guideline is the rapid, steep price trend, flagpole. If price is meandering up or down and forms a flag, then look elsewhere. The flag must be a place where the stock can take a breather from its rapid pace. Price moves against the short-term trend for several days before continuing on or not. Focus on failures. Like all chart patterns, flags are not immune to failure. Figure 34.4 shows a flag failure. The flag, while obeying the confines of the two down-sloping trend lines, has a good volume trend. Price should continue higher after the flag completes but does not. Why? One explanation is that the flag is just too long at 26 days. Sometimes an excessively long flag suggests an impending failure or a weak price move after the breakout. Trade flags more than 3 weeks long carefully or pass them up entirely. In this example, the flag is not proportional to the flagpole, suggesting the need for caution trading it. Figure 34.5 shows a more common failure, one of performance. The decline in the February flag begins at a 43 and ends at B 38.90 for a run of 4.10. The decline from C to D measures 3.06. If flags were true half-staff patterns, the two runs would be about equal. Since this is but one example, the results snapshot shows that only about half the flags hit their price targets. In this example, the flag has to chew through trendline support just beneath the flag. The dip is brief, as sometimes happens in trendline pierces, and price recovers only to surge upward, eventually making a new high. Also, the slide from A to B could be more robust, longer, like the down move leading to the November flag. We'll see in Table 34.11 that when a flag tilts with the price trend downward, in this case in a downward price trend, performance suffers. And that's what we see here with the ABCD pattern. Statistics. Table 34.2 shows general statistics for flags. The performance statistics do not use the usual ultimate high or low method measure, that is, looking for a 20% trend change. Instead, I looked at the beginning and ending of the price trend, usually the nearest minor high or low after the breakout. Thus, comparing this pattern to other patterns except pennants, which use the same method, is unfair. Number found. I uncovered 1278 flags without really trying in 462 stocks, with the first appearing in October 1991 and the most recent in December 2019. Not all stocks covered the entire period, and some no longer trade. Many flags were just a few days long, and they are a colossal pain to catalog because they are so small and so plentiful. Reversal R, continuation C occurrence. Most of the time, a flag acts as a continuation of the prevailing very short-term price trend. Flags in bull markets with downward breakouts see the most reversals, but continuations still outnumber reversals. Reversal and continuation performance. The best performance comes from flags in bear markets after downward breakouts that act as continuations. That means price is already dropping before the flag appears. Because a rising tide lifts all boats, I would expect to see continuation flags in bull markets with upward breakouts also do well. But they perform the same as in bear markets, psi, average rise or decline. If you ignore how the pattern behaves reversal or continuation and measure the move from the breakout to the trend end, we see what I consider unusual results. Again, I'm looking for the general market to help performance, but I don't see it trade with the trend. That would apply to bull markets with upward breakouts, second to worst in performance, and bear markets with downward breakouts perform best. Standard & Poor's 500 change. Compare the general market rise or decline by the rise or decline after the flag breakout. Perhaps the large drop in the index in bear markets and down breakouts helped those flags outperform the others. Days to trend high or low. Because I'm looking for the trend end and not the ultimate high or low, it's a short time away. Notice that bull market /up breakouts and bear market /down breakouts show slightly longer trends. Those two are the trade with the trend columns. The middle two columns are countertrend patterns. I removed Table 34.3 showing failure rates because they don't apply to flags. Failure rates are a function of the move to the ultimate high or low, and flags measure to the short-term trend end. Table 34.4 shows breakout-related statistics. You'll notice that throwbacks and pullbacks do not appear in the table. That's because they happen after the trend ends by definition, and so don't relate to the performance of the flag. Breakout direction. The table shows the breakout direction. A breakout occurs when price closes outside of the flag boundary. Yearly position performance. Flags with breakouts near the yearly low perform best. Those near the yearly high perform worst, except after upward breakouts in bull markets. There, the middle third of the yearly price range is worst. Just remember that the performance for flags is the move to the trend end, not the ultimate high or low. Gaps. Only in bear markets after upward breakouts do gaps show a significant performance difference. A flag without a gap tends to perform better in most cases. Table 34.5 shows pattern size statistics. Height. Height is a function of the flag portion of the pattern, not including the flagpole. I measured the height from the top of the flag to the bottom and divided by the breakout price. Flags taller than the median shown in the table outperformed in all cases. Width. Notice how narrow the median width is. Patterns wider than the median outperform in 3 of 4 columns, with bull markets and upward breakouts being the exception. Remember, I put a limit of 21 days on flag length, height, and width combinations. Flags that are both tall and narrow do well in the trade with the trend columns, that is, bull market and up breakout and bear market and down breakout. They also show the larger performance differences. Pay attention to the worst performing combinations when you trade. You'll want to avoid those. Clearly short flags suffer more than tall ones, but check the width too. Table 34.6 shows volume-related statistics. Volume trend. In all cases, volume trends downward most of the time. I used linear regression on volume from the start to end of the flag to determine the trend. Rising and falling volume, breakout day volume. As you scan across the rows and columns in the table, there is not a great deal of performance difference between the numbers vertically. For example, rising and falling volume in bear markets after upward breakouts sees no performance difference. Light breakout volume sees a 1 percentage point difference, but that's probably statistically insignificant. Table 34.7 is supposed to show how often price reaches a stop location. Because I measure the move from the breakout to the trend end, the next nearest minor high or low, a straight line run, the stop location will not trigger until after the trend ends. So I removed the table from this chapter. It's not meaningful. Table 34.8 shows the performance over 3 decades, performance over time. This measures the length of the trend after the breakout in bull markets only. Both breakout directions show the trend shortening over time. It suggests failures will be higher. Table 34.9 is supposed to show busted pattern performance, but it doesn't apply to flags, so it doesn't appear in this chapter. Trading tactics. Consult figure 34.6 as I review the tactics listed in table 34.10. When trading flags, you must first be sure you have a valid formation. Use the identification guidelines outlined in table 34.1 to ensure that you have correctly identified a flag, including the flagpole. Measure rule. The measure rule sets the expected price move. First, determine where the trend begins, which is usually the minor high for downtrends or low for uptrends preceding the flag at the base of the flagpole. Figure 34.6 shows the flagpole beginning at point A, the start of the straight line downhill run. Subtract the low at the flag start, point B at 42.75 from point A, 47.50, giving a height of 4.75. Subtract the height from the high at the formation end, point C at 43, to give the target price of 38.25. Price reaches the target 13 trading days after it moves below the flag trendline. Notice that I'm calculating each leg using the longest length, from the high price at A to the low price at B and then the high at C to the target. So if the flag slopes in a different direction, you'll still know how to do the math. How well does the measure rule work? Not very. The results snapshot at the beginning of this chapter shows the results in the percentage meeting price target row. Success varies from 46% bull markets to 53% or 54% for bear markets. In other words, price reaches the target about half the time. Use the measure rule to gauge the amount of profit likely from the trade and weigh the amount of profit against the possible risk of failure. Look for support and resistance levels where price trends were repulsed in the past. Many times price will pause or turn around at these junctions. These values become the risk points for a trade. You can compare the risk with the reward by computing the current price with the measure rule target and the first or second level of support or resistance. Adjust the profit potential to use the anticipated entry price. The measure rule uses the top of the flag on the last day, but your entry price will use the bottom of the flag. For the stock shown in figure 34.6, the target is 38.25 as calculated above, but the entry price is the bottom of the flag, or 42.49, a penny below the flag bottom for a potential reward of 4.24. That is, 42.49, 38.25. The first resistance level is at 44, and there is another at 45, assuming the trade goes against you and price rises. A stop placed at 44.13 or so, slightly above the first resistance level, works well. Wait for breakout. Take a position in the stock as it breaks out as price moves outside the flag boundary. If you're swing trading the flag, it's important to get into the trade quickly because the potential gains are small. I would place an order to enter the trade at the flag trend line and monitor the trade closely. Once price nears the target, as predicted by the measure rule, consider closing out the trade. Since the statistics regarding the success of meeting the predicted price target are poor, be ready to close out the trade sooner than expected. If you wait for price to reach the target, you might turn a profitable trade into a losing one by holding too long. Table 34.11 shows how flag tilt affects performance. The flag in figure 34.1 slopes upward, tilts upward. The flag in figure 34.4 tilts downward. I found that when the flag tilts against the price trend, performance improves. For example, in a bull market after an upward breakout, if a flag tilts upward following the upward price trend, the stock sees an average rise of 6%. Flags that tilt against the upward trend see price rise 10%. Notice that upward breakouts do best with down-tilting flags, and downward breakouts do best with up-tilting flags. Both cases do best when the flag tilts against the short-term price trend. Table 34.12 takes a magnifying glass to the move before and after the flag. For two continuation patterns, rising price trend with an upward breakout and a downward tilting flag, and the reverse, falling price trend, downward breakout and upward tilting flag, I measured the price and time moves. Let's talk about the bull market results for the first continuation pattern, and you can apply the same logic to bear markets in the second continuation pattern. Time move. If we expect the flag to be in the middle of the trend, I found that's not true. The flagpole averaged 15 days long, but the move from the breakout to trend end was 12 days long, so expect a quicker end to the move after the breakout, price move. I measured the same two legs flagpole move and flag breakout to trend end. I found that the flagpole saw price move 19%. After the breakout, price moved less, 17%. Multipliers. This item uses the results of the prior rows to figure out how much to multiply the flagpole to get a better estimate of how long and how far the stock might move. For example, suppose you see a flag with a flagpole height of $5 in a stock trading at $26. The flagpole is 5 divided by 26 or 19% of the current price. I know from the table that the average move after the flagpole ends is 17% along a combined height of 19% plus 17% or 36% high. So 17 divided by 36 is 47%. If I take 47% of $5 and add it to the breakout price, I should get a better estimate of how far price might rise. If the breakout is at $25, price retraced $1 in the flag before breaking out upward. The target would be 25 plus $5 times 47% or 27.35. Clear as mud. How long will it take to reach the target? Say it took 11 days to rise to the top of the flagpole. The time multiplier is 44%. So I'd take 44% of 11 days, which is 5 days, rounded up, and that's what I would add to the breakout date. If it's a weekend, then you can use either Friday or Monday as the target. Experience. I've entered trades a number of times using flags, but few times have I traded it like a flag, using the measure rule as a target. Here's what I learned. It assumes the flagpole is upward and flag tilt is downward. After the flag becomes recognizable, like a week after the flagpole, place a buy order at the bottom of the flag. If the flag breaks out upward, you get in sooner than if you place a buy order at the top flag trend line, or if you wait for a close above the flagpole high. Either work, but you cut potential profit. I used this entry method a few times with success, but once the flag broke out downward and I suffered a loss. A downward breakout is a risk with this early entry mechanism. Don't wait for price to close above the top flag trend line and enter at the opening price the next day. Why? Because it's too late. If a flag works like it's supposed to, which is rare, when price breaks out upward, it starts a strong push upward. So waiting a day means you could be halfway to the target. So use a buy stop a penny above the top flag trend line or at another location as discussed above. Place a sell order at the target. With short-term trades, such as with flags, the stock could hit the measure rule target and then drop thereafter. I've seen that a lot. If you have an order to sell waiting at or near the target, you can get out on time. I had one flag trade where it reached the measure rule target, one of the few, but I didn't sell until the next day and gave back too much profit. The stock continued lower too. It will be rare for the stock to reach the target before a significant retrace. Many of the flags I looked at didn't follow through with a straight line push higher to the target. They meandered higher instead. If price breaks out upward rising from the flag but then closes below the bottom of the flag, sell. The stock will likely continue lower. I had that happen twice and lost money after the reversal. Keep the stop tight after an upward breakout. Plan for the stock to miss the measure rule target. I see this often in flags. Of course, the results snapshot says price will reach the target only 46% of the time in bull markets, where I like to use flags. Try computing the measure rule target, but use something like 75% of the flagpole height projected upward to get a more conservative, closer target. Sample trade. Let us say you are considering shorting the stock shown in figure 34.6. Since the price trend is downward in a bull market, the results snapshot says that 46% of the flags will meet their price targets on average. That is a poor showing and deserves caution. As the flag forms, you monitor the price closely by not only charting the end-of-day price, but also checking it midday. When you dial into your broker for a lunchtime price quote and discover that price has moved outside the bottom trend line, you decide to pull the trigger. You sell short and receive a fill at 42, most of the way down price bar C, just above the closing price of 41.50. Note, an order to enter the trade a penny below the flag low, 42.49, would have worked well in this situation, but sometimes setting the entry price can be difficult if the flag is loose-looking. You follow the stock closely as price declines. Looking back through the prior year's trading history, you discover two support levels at about 40 and 39. You believe that the stock will fall through the first support level, but the second one may be more difficult. It is, after all, closer to the 38.25 target price and more robust than the first level. When the stock moves sideways at the first support level, you check your work and re-examine the fundamentals and technical indicators. Everything seems good, so you remain in the trade. Eventually, the stock pierces the first support level and declines to the second one, where it gets stuck. It closes at 39, but the next day moves up. So the following day you decide to close out your position, believing that the risk of a price rise far exceeds the possible gain. Your short sale covers at 39 and you receive almost $3 a share. That is not a bad profit for a hold time of just 2 weeks. On an annualized basis, the return is wonderful. 35. Flags high and tight. Results snapshot. Appearance. After a stock doubles in price, a consolidation region of several days to several weeks long appears, followed by an upward breakout. It seems that as soon as the second edition of this book came out and proclaimed that the high, tight flag was the best performing chart pattern in both bull and bear markets, the chart pattern stopped working. Now, performance ranks near the bottom of the list, 30 out of 39, where one is best bull market. I noticed the performance decline but suffered through losses until I figured out this pattern didn't work. I'd see price climb 10% to 15% after a breakout, and then collapse. After a bear market, I'd see price double, form the flag pattern, and either die right then or rise by the same 10% or 15% before collapsing. During the COVID-19 pandemic of 2020, we saw the same behavior. I warned readers of my blog not to trade this pattern, and I was right. I think I saw one flag perform as expected, but dozens of others failed. Let's take a tour to see what the pattern looks like. Tour. Figure 35.1 shows a classic example of a high, tight flag. The quick rise from the low point at 14 to the flag high at 30.75 took less than 2 months. The volume trend was downward throughout the chart pattern. After a slight pause, the stock continued rising. In another 2 months, it reached a peak of 120. That's the way the pattern used to work in the glory days of the 1990s. The high, tight flag is a momentum play by high, sell higher. When a stock doubles in a short time, it usually takes a breather and consolidates. When it does, it gives the trader the opportunity to buy the stock before the rise resumes. How do you correctly identify a high tight flag? Identification guidelines. The phrase high tight flag is a misnomer because the pattern usually does not resemble a flag at all. Sometimes price moves up slightly as the flag progresses, such as shown in figure 35.1, but more often price spikes down briefly a day or two, then returns and moves downward or horizontally before breaking out and heading up. William J. O'Neill popularized the pattern in his book, How to Make Money in Stocks, McGraw-Hill, 1988. In his introduction to the pattern, he identifies many characteristics that high, tight flags share. Briefly, O'Neill looked for a doubling of the stock price in less than 2 months, a sideways move of 3 to 5 weeks during creation of the flag, with price drifting down no more than 20% in the flag. The guidelines eliminated many patterns so that fewer than 10% of the ones I looked at qualified. I followed none of his guidelines. I prefer to let the pattern tell me how it behaves. I programmed my computer to identify all stocks that had a minimum price rise of 100% in 2 months or less. Then I manually went through each stock and looked for a nearby consolidation region. If the region was close to the 100% price gain, then I accepted it as a high, tight flag. For example, the figure passes all the O'Neill guidelines, whereas figure 35.2 does not, if you apply them strictly. The stock reaches a low of 5.25 in early July, then starts moving up. In early September, it reaches a price of 10.25, just shy of doubling. Admittedly, the 95% price gain is less than a strict interpretation of the O'Neill guidelines, but it comes close. The high, tight flag slopes downward for 38 days, 3 more days than the maximum, and declines by 22%, 2 percentage points over the threshold. You could argue that the numbers are close enough to the O'Neill guidelines to qualify as a high, tight flag. I accept it as a valid pattern. The stock climbed 28% before dropping by 20%. Table 35.1 shows the guidelines I used in selecting and evaluating high, tight flags. Appearance. Look for a short, quick rise. By that, I mean a rise in which price nearly doubles in 2 months or less. It can move up more than that, and the rise need not take place from a flat base, horizontal price movement. In the high, tight flags I found, I looked for a doubling of the price in 2 months and then let my computer determine when the trend started. See Trend Start in the glossary for details. You will want to avoid price trends where the trend in the month or two leading to the start of the flagpole is steep, either up or down. Shallow inbound trends are best. I'll discuss this in the experience section. Flag consolidation. Once we have a tall flagpole, a doubling of price in 2 months or less, look for a consolidation area to form. In my selections, I did not care how long the stock consolidated nor how far the flag descended before turning upward. All that mattered was that the consolidation area was plainly visible to the casual observer. Volume. The final identification guideline is not really for identification as much as it is for performance. Flags with receding volume outperform those without. However, I would not ignore a high, tight flag simply because volume is rising. Rather, I would recognize that performance may suffer. Breakout direction. The breakout is upward by definition. If the stock breaks out of the flag consolidation area downward, then look elsewhere. I prefer to wait for price to close above the top of the flagpole before taking a position. Duration. Price must double in 2 months or less. That doubling becomes the flagpole. Focus on failures. Investing in a stock showing a high, tight flag is not without risk. Figure 35.3 shows a quick, nearly vertical rise the flagpole, leading to creation of the flag. As the rise falters, high volume tapers off. When price heads lower in the flag portion of the pattern, marked in this case by 2 down-sloping trend lines, volume recedes. That's how it should be in well-behaved patterns. The flag drifts lower for almost a month before price breaks out of the trend and resumes rising. After climbing for just over a week to a new high, the stock curls around and meanders lower. It throws back to near the base of the flag and then moves horizontally for several months before dropping lower again. The figure shows a flag that suffers from a small rise, and it's typical of this pattern's failure. After price breaks out of the flag upward, it is supposed to double again. However, in this case, price stops rising just above the flagpole high. In my analysis of this pattern, I found that 38% will fail in this manner. However, A bunch of potential high, tight flags never get this far. The second type of failure for this pattern is the failure to break out upward. As I mentioned, I see that a lot. It's why I suggest traders not only wait for price to close above the flag, but to close above the flagpole too. Statistics. Table 35.2 shows general statistics. Number found. I found 1422 high, tight flags in 578 stocks, with the first pattern appearing in February 1991 and the most recent December 2019. Note that I did not log the COVID-19 failures in this edition because some haven't reached the ultimate high yet. Reversal R, continuation C occurrence. Since I was looking for an upward breakout only after a sharp price rise, the flagpole, each flag acted as a continuation of the prevailing price trend. Average rise. The average rise measured from the breakout price, often it's the opening price the day after price closed above the flagpole high, to the ultimate high. Standard & Poor's 500 change. The S&P climbed a bit as measured from the high, tight flags breakout day to the date of the ultimate high. Notice that a strong market uptrend tends to push price higher, that is, the average rise is higher in bull markets than bear markets. If you're starving for cliches, then I have two. A rising tide lifts all boats and trade with the market trend. Days to ultimate high. High, tight flags are rockets, reaching the ultimate high in about a month to 6 weeks on average. The median is just 18 days. That's fast. How many change trend? This is a measure of how many flags see price rise more than 20% after the breakout. I consider values more than 50% to be good, but 55% is the average for all bullish chart patterns. Bear markets fall short of the average made by all other chart pattern types, which see 46% rising more than 20%. Table 35.3 shows failure rates for high, tight flags. I found that 15% of the patterns will fail to see price rise more than 5% after a bull market breakout. Over a third, 38%, will fail to see price rise more than 15%. This is the kill zone, a rise of 10% to 15%, where I've noticed a lot of the patterns die. Table 35.4 shows breakout-related statistics for flags. Breakout direction. By definition, the breakout is always upward. If price closes below the bottom of the flag, then that's a downward breakout. Ignore the pattern. It's a high, tight flag that's failed. Yearly position performance. Where in the yearly price range do the best performing flags reside? Those patterns with breakouts within a third of the yearly high tend to perform best in both bull and bear markets. Avoid flags with breakouts in the middle third of the yearly high-low range. Throwbacks. Throwbacks occur over 2/3 of the time and take between 11 and 12 days, on average, to return to the breakout price. When a throwback occurs, performance suffers, which is typical for many other chart pattern types too. After a throwback completes, price resumes rising between 39% and 52% of the time. Those results don't exactly inspire confidence that price will make a determined push higher. Gaps. A gap that appears on the day of breakout helps performance. In bull markets, the extra push is only 1 percentage point, but in bear markets, the performance difference is wider, 4 percentage points. Because I tabulate performance using the opening price the day after a gap appears, you can participate in the performance by buying the stock after the gap. Table 35.5 shows pattern size statistics. Height. There's not a substantial performance difference between short or tall flag patterns. Height in this case does not include the flagpole, it's just a measure of the high-low range of the flag. Width. Width measures from the start of the flagpole the trend start to the end of the flag. In both markets, wide patterns do better than short ones. I used the median length as the separator between narrow and wide, height and width combinations. I looked at the combinations of height and width and found no consistent trend from bull to bear markets except that tall and narrow patterns performed worst. You'll want to avoid those. Table 35.6 shows volume-related statistics. Volume trend. Volume trends downward most often, more than 80% of the time. That's probably because volume tends to spike during the creation of the flagpole and diminishes in the flag. Rising and falling volume, breakout day volume. Again, there's no consistent performance difference between bull and bear markets. However, the performance differences per market can be wide enough that you'll want to pay attention to rising and falling volume or heavy and light breakout day volume in each market, bull or bear. For example, in bull markets, patterns with falling volume and light breakout day volume do better than the other combinations. Table 35.7 shows how often price reaches a stop location. Because the stock doubles in the flagpole, you probably won't see price make it back down to the middle or the bottom of the flagpole. I'm using the entire height of the pattern here, from start of the flagpole to flag end. I did measure how often price touched the bottom of the flag, and the table shows the results. The flag is a good place to hide a stop-loss order, providing it's not too far away from the entry price. Table 35.8 shows the performance over 3 decades. Performance over time. This shows how pattern performance has deteriorated over time. It performed much better in the 1990s than it did in the 2010s. Failures over time. Failure rates were constant for 2 decades, but rose by 50% from 14% to 21% in the 2010s. I did not include Table 35.9 because the pattern is too tall to bust too few samples. Trading tactics. Table 35.10 shows trading tactics. Measure rule targets. Use the measure rule to predict a target price. To calculate the price target, find where the trend starts the bottom of the flagpole and measure the price change from the low at the start to the highest high in the pattern, often the top of the flagpole. Divide the result in half and add it to the flag's low price. The result is the target. The bottom portion of the table shows how often various heights used in the computation work. Using half the pattern's height, as suggested above, we see the measure rule works between 78% and 82% of the time. Using taller heights means a lower success rate, but more potential profit if price rises that far. Flagpole top. I highly recommend you wait for price to close above the top of the flagpole, top of the pattern, really. Why? Because I've seen too many patterns where price breaks out upward from the flag and reverses before reaching the flagpole top. You want to give price every opportunity to reach a new high, so wait for the stock to clear the top of the pattern. Stop location. The bottom of the flag makes for a delicious stop location. See Table 35.7 for details. Experience. No single failure type stands out in my trades. However, I did notice that the pattern failed to live up to expectations, that of price doubling after the breakout. In several trades, I saw price climb by 20% or less, reverse, and make a substantial decline. Lesson: don't expect price to double after the breakout. I was stopped out of several trades by entering before price closed above the top of the flagpole, that is, price left the flag boundary but reversed before closing above the flagpole top. I learned to wait for a better entry, a close above the flagpole high. Lesson: wait for price to close above the top of the pattern and then buy. With other trades, I made a good entry and the pattern just didn't deliver. However, I did have success with one, and I wrote an article about it, a trade in Steel Industries, E-in. The stock climbed smartly after the breakout and paused along the way upward. I thought the uptrend was about to end, so I sold my position for a 28% gain. If I had hung in there, I'd have made best case 93%, or almost double my money. That would have been a perfect trade, and so you can see what the difference is between a perfect trade and real-world results. I researched how the pattern behaved as we came out of the 2009 bear market. Stocks doubled in price, and that's as far as they got. Now, in mid-2020, I see the same pattern. I see dozens of high, tight flags where price has doubled from the March 2020 low, which are now failing to climb. With some, it's too soon to see where the ultimate high is. With others, price rises by a few percent and then collapses. Lesson: after bear markets, you'll see lots of high, tight flags that fail to break out upward, or if they do, the rise is meager. I conducted a study of the slope of the inbound price trend in the month or two before the start of the high, tight flag. I found that if the slope was shallow, either up or down, performance was good. If the inbound trend over that month or two was steep, either steep up or steep down, then performance was bad. The best combination was a shallow drop over 1 month leading to the start of the flagpole. In second place, just 1 percentage point behind in performance, was a 1-month shallow up move leading to the start of the flagpole. In other words, a shallow inbound price trend leading to the bottom of the flagpole is good. You'll want to avoid steep inbound price trends. What we're seeing now in the markets after a steep plunge in the market indices is many high, tight flags that fail to perform as expected. They have a steep inbound price trend. Lesson: avoid trading a high, tight flag that has a steep inbound price trend leading to the start of the flagpole. A shallow drop of 1 month leading to the start of the flagpole is best. Sample trade. When John spotted the high, tight flag shown in figure 35.4, he wasted no time in taking a position, buying when price pierced the upper trend line at point A. He placed a stop 13 cents below the formation low at 5.63. 2 days later, he was stopped out. "A billion here, a billion there, and pretty soon you're talking real money," he said. He backed off for a few days and waited for the stock to climb above the flagpole top 6.50. When it did, he piled into the stock again at 6.50. He considered the bottom of the flag a support area, so that is the price he used as his stop loss. This time, however, he used a mental stop, one that is not placed with a broker but kept in his head. There is really no problem with a mental stop, providing an investor or trader is willing to sell should price hit the stop. Now and again, John looked at the price chart just to see how the trade was doing. The stock climbed to a support zone at 8 and went horizontal for 3 months. Toward the end of that time, he raised his mental stop to 7.75. The stock climbed again. It ignored the double top formed by peaks in early January and late February, and so did John. By April, the stock posted a new high, quietly disclosing that the double top turned out to be false. It never confirmed as a valid chart pattern. When the stock passed $13 in mid-April, I started to pay attention. It reached 13.25 and backed off for a bit, sinking to a low of 11.13. Then it spurted up again. I drew a trend line upward following the latest move, and when price pierced the line, I got my broker on the blower. John sold at 13.63, not close to the high of 15.88, but close enough for government work. After commissions, he made 108% in slightly less than 8 months. 36. Gaps. Results snapshot. Appearance. A price gap appears when the current low is higher than the prior high or the current high is below the prior low. There are 6 types of gaps, 4 of which I review in this chapter. The ex-dividend gap is not considered because it rarely has any investment significance. The ex-dividend gap usually occurs in utility stocks or stocks with high-paying dividends. On the day of dividend distribution, the price sometimes moves downward, leaving a gap on the price chart. Even though the price of the stock after distribution is reduced by the dividend amount, the day's trading range often fills the gap, so no actual gap appears on the chart. The opening gap happens nearly all of the time on intraday stock charts. It is the gap between yesterday's close and today's open. If the gap remains open throughout the day, it can form one of the other gap types: area, breakaway, and so on. For end-of-day traders, opening gaps don't have much significance. For intraday traders, opening gaps give a day trader the opportunity to make a lot of money quickly, often by fading the gap. For more details, read my book, Evolution of a Trader, Swing and Day Trading Wiley, 2013. In the above results snapshot, I show how often the various gap types close within a week. I sorted it not by the breakout direction but by whether price gaps up or down. I define closing the gap to be when price returns and spans, covers the gap completely. The area gap closes quickest, with 85% to 92% of those gaps closing within a week, depending on the bull or bear market. At the other end of the scale, we find breakaway gaps rarely, usually 1% close within a week. In the middle are exhaustion gaps, which close the gap quickly, and continuation gaps, which usually stay open longer than a week. Tour. Price gaps upward when yesterday's daily high is below today's low price. Price gaps downward when yesterday's low is above today's high. In both cases, some type of exuberance is driving the stock to create a gap, provided the stock is not thinly traded. Sometimes a gap is nothing more than the stock being worth less simply because of a dividend distribution. At other times, the repercussions are more severe. An earnings surprise, either positive or negative, can cause a gap and the stock to rise by 10% or 15%, or to decline by 30% or more, depending on the severity of the news. Figure 36.1 shows a plethora of different gap types. Area gaps occur in congestion zones, often when price is moving sideways. Price gaps up or down and the gap closes quickly. Of all the gap types, area gaps are common, like potholes on a dirt road. Breakaway gaps appear at the start of trends. They too are quite numerous, and high volume accompanies them. Usually there is some fundamental event driving the stock, creating a breakaway gap. Continuation gaps are relatively rare because they appear in the middle of strong trends. Those trends themselves do not occur very often, and even less often do they contain a gap. Exhaustion gaps signal the end of trends. They are the last jump up or down before the trend either reverses or moves sideways. After an exhaustion gap, price can suffer a violent reversal, so if you don't exit a trade quickly, you may find profit dwindling. Identification guidelines. Table 36.1 lists identification guidelines for gaps. Area gaps. Area, common, or pattern gaps are all names for the same type of gap. The gap forms inside or just after a consolidation region. It is easy to spot because price seems to hook around and closes the gap in less than a week, many times in the next trading session or two. Figure 36.2 shows many examples of this hook feature. For example, you can see if you have a magnifying glass in late March that price gaps down, and the next day the high closes the area gap. A quick hook such as that is characteristic of area gaps. Usually, few or no new highs for uptrends or lows when price gaps lower occur immediately after the gap. Volume may be high on the day price gaps but usually settles down quickly. You can see this behavior in late January. Volume spikes on the gap day, then returns to normal the next day. Breakaway gap. Breakaway gaps highlight the start of a new trend. Volume rises substantially above the prior day and price gaps upward and continues rising or falling in the case of a descending price gap, forming new highs or lows. Consider the breakaway gap in early April shown in figure 36.2. You can see price gap away from a congestion region, and price continues rising for several days, accompanied by rising volume. The large breakaway gap in mid-April, accompanied by a high volume spike, is not an exhaustion gap because price continues rising. Price moves sideways starting after the peak in April and continuing into June before a breakaway gap sends price lower. The gap, along with the one in April, leaves behind an island reversal chart pattern. Both gaps that set off the island reversal occur on high volume and are probably event-driven. Some news happened, but that's just a guess. Usually tall gaps are associated with exhaustion gaps, but price continues moving lower in the June case, so the gap is a breakaway gap. Continuation gaps. Continuation gaps occur along a strong price trend. They do not happen often since it takes a sharp rise followed by a gap and a continued rise in the stock, the reverse for downtrends too. In figure 36.2, you can see several continuation gaps in August when price zooms from a low of 23.50 to 32.63 in about 2 weeks. The gaps appear in the quick, sharp price rise on high, but not unusually high volume. The quick rise forms new highs and the gap remains open. Compare these continuation gaps with how quickly area gaps close. Of course, in a downtrend, price gaps downward and forms new lows. Ex-dividend gaps. An ex-dividend gap appears on the price chart when a dividend-paying stock distributes the dividend. Usually, however, the day's trading range will cover the gap. Exhaustion gaps. Exhaustion gaps commonly follow continuation gaps, but there are lots of exceptions. Excessively tall gaps are most likely exhaustion gaps when they appear near the end of a trend. An exhaustion gap appears on the chart in September. The gap appears at the end of a downward move and closes quickly, which is typical for exhaustion gaps. Notice how a violent reversal occurs after the gap completes. Price rises from a low of about 26 to almost 31 in a few weeks. Most exhaustion gaps occur on high volume. It is like the last gasp before price ends the trend. You can see in the figure that the exhaustion gap has high volume. Volume spikes upward even as price descends, then volume recedes but remains high for several days after the gap. High volume highlights the struggle of investors who want to purchase the stock at a good price with those who are trying to get out of the situation at the best offer. Opening gap. This gap type comes in two varieties, full and partial, which describes if the gap ventures outside of the prior day's high-low trading range, full or not partial. Because it's on the intraday scale, I don't cover it in this book. As I mentioned, my swing and day trading book gives full treatment of this gap. Statistics, area gaps. In the tables that follow, the presentation is different than in many other chapters of this book. I don't measure performance of gaps in terms of the ultimate high or low. Rather, I search for details that describe the behavior of the gaps. The table headings show up and down gaps, not up and down breakouts. The difference is in the direction price gaps up or down. An up gap, for example, occurs when today's low price is above yesterday's high price. A down gap happens when today's high is below yesterday's low. Table 36.2 shows general statistics for area gaps. Number found. I didn't do an exhaustive search for gaps because it was, well, exhausting. I used 287 stocks from July 1991 to November 2018 and found 4347 gaps. They split into bull and bear markets, up and down gaps, and 4 gap types. For area gaps, I found 1140 of the critters. I should have called the exterminator. Average time to close the gap. On average, it takes about 4 days for price to cover the gap, regardless of market condition or gap direction. In bull markets, when price gaps upward, the closing time is 1 day longer than the other varieties. Percentage closed. The table shows the closure rates. Nearly all of the area gaps close in the first week or two. You can scan down the other tables to see the closure rate compared to area gaps and verify that area gaps close a lot faster in days, not weeks or months, than the other types. Average gap size. Area gaps in bear markets are about twice as tall as those in bull markets. Why this is the case is a mystery to me. The smallest gaps occur in bull markets, with a downward direction, price gaps downward. That makes intuitive sense if you think of the bull market as a current going in one direction and a down gap as gapping in the opposite direction, downward. It's like trying to ride a bicycle against the wind. However, if that's really the case, then why is the up gap in bull markets also showing a small gap? Both are moving in the same direction. I don't know. Statistics, breakaway gaps. Table 36.3 shows general statistics for breakaway gaps. Number found. I found 1580 breakaway gaps. That high number of gaps is a small sample of how often these gaps occur. You'll see them bust out of a consolidation region, often on high volume, which tends to remain high. Average time to close the gap. The average time for the gap to close varies from 195 days, about 6.5 months, to 430 days, 14 months. The 430 number is pulled up by about 24 gaps that don't close for years. Percentage closed. Breakaway gaps do not close quickly, as Table 36.3 shows. Few close in the first week. Those that do close in a week make a strong trend for about 3 days, followed by a violent reversal. The trend is too tall to consider them area gaps. After several months, there's a number of breakaway gaps still open. Average gap size. The average gap size varied across market conditions and gap directions, with downward gaps being larger than upward ones. Statistics, continuation gaps. Table 36.4 shows general statistics for continuation gaps. Number of formations. I found 763 continuation gaps in the stocks I looked at. Continuation gaps occur during an existing trend, often on high volume. Average time to close the gap. Compared to breakaway gaps, continuation gaps close quicker, as one might guess, because breakaway gaps appear near the trend start but continuation gaps appear in the middle. The longest takes almost a year to close. Percentage closed. I show how fast or slow continuation gaps close over time. After about a month, half the gaps remain open. After 6 months, some still remain open. Average gap size. Downward gaps in bear markets are the tallest. I know that bear markets see price drop about twice as fast as it rises in bull markets, so I'm wondering if gaps help that process. Gap position. I measured where in the price trend the gap continuation gap appeared. The median gap location from the trend start to the end of the trend is about midway, regardless of market conditions, bull or bear, and gap direction, up or down. I was surprised by this, but pleased too. I like to see consistent results across different conditions. Statistics, exhaustion gaps. Table 36.5 shows general statistics for exhaustion gaps. Exhaustion gaps occur near the end of the trend, often on high volume. They can be especially tall, so if you see an unusually tall gap, there's a good chance it'll be an exhaustion gap, no guarantee though. Figure 36.2 shows 2 big gaps that set off the island reversal, but they are breakaway gaps, not exhaustion ones. Remember that after an exhaustion gap completes, there can be a violent reversal. That's why our prisons are so full. Number of formations. I found 864 exhaustion gaps in the stocks I looked at. Average time to close the gap. Exhaustion gaps close quickly, usually between 1 and 2 weeks on average. Percentage closed. The table shows how quickly exhaustion gaps close. In 1 week, about 2/3 of the exhaustion gaps close. In 3 weeks, many of them are closed with bear markets closing slightly faster than bull markets. Average gap size. The average gap size varies, with the largest appearing in bear markets with downward gaps. Trading tactics and sample trade. Table 36.6 lists trading tactics for gaps. To successfully trade gaps, you have to be quick, making sure to use stops, and you have to be ready to close out a trade at a moment's notice. Still, they can be profitable. Consider what Gina did with the situation shown in figure 36.3. As a seasoned investor, Gina knew all about gaps and practiced trading them on a trading simulator until she was successful most of the time and comfortable taking a loss. The practice honed her skills, and pulling the trigger seemed rote. With a focus on limiting her losses, she was growing confident that her trading style was one that would allow her to succeed in the markets, so she took the leap and decided to trade her system for real. I followed the stock for a long time and was both familiar and comfortable with the fundamentals of the company. When the breakaway gap occurred on 10 May, I was ready. I checked the identification guidelines. Volume was above average, although it may not be clear from the chart, and a new upward price trend seemed to be forming. I called my broker and bought 1,000 shares at 58. Then I placed a stop-loss order at 57.00, or 13 cents below the lower gap rim, just to be safe. If this turned out to be an area gap, she would probably be stopped out for a small loss. During her paper trading days, she discovered that most gaps provide near-term support or resistance, so she was confident that her stop would hold. 2 days later, the stock gapped again. It could either be a continuation gap or an exhaustion gap. I didn't know which. Volume was heavy, about twice the 25-day moving average, so that offered no clue. The following day, price gapped again, so I knew the prior pattern was a continuation gap. Gina checked the price chart, and using the center of the continuation gap as a midpoint, she measured from the trend low point A in the figure to the center of the gap. The difference was 5.50, that is, 60.25 minus 54.75. Adding the difference to the middle of the continuation gap predicted that price would top out at 65.75, so she placed a stop at 65.50, and moments later, the stock was sold. That day, the stock climbed to a high of 66, slightly above the predicted price, and closed the day at 63.25. Not including commission charges, she made $7,500 in just 4 days. But she was not done. The tall daily price range on high volume when she sold reminded her of a 1-day reversal, but she was unsure. She decided to keep her options open and looked for an opportunity to sell short. She followed the stock daily, and when it closed below the support level at 61, she decided to sell the stock short and received a fill at 59. The next day, I was surprised and delighted to discover that a large exhaustion gap had formed, dropping the stock down to 49, for a $10,000 gain overnight. Knowing that the gap was in reality a dead cat bounce, she changed tactics and did not immediately close out her position. Instead, she watched the stock bounce upward for a few days and then continue lower, as the formation predicts. Instead of getting greedy, she decided to close out her position and received a fill at 45, for an easy $14,000 profit in less than 2 weeks. If you think Gina was lucky, netting over $21,000 in 2 weeks, you are right. But her ability to correctly size up an investment opportunity and act on it quickly while taking steps to minimize losses goes a long way to explaining her luck. Some call it skill. Gina is a serious investor who leaves nothing to chance. She did not just jump in and start trading gaps after reading about it in some book. Instead, she researched the pattern, followed the stock closely, and developed a successful trading style that incorporates gaps. It worked for her, but it might not work for you. Experience. Figure 36.4 shows the sale of a stock I owned a long time ago, based on the appearance of 2 gaps. In early 2013, Georgia Gulf Corporation (GGC) merged with a portion of PPG Industries, and then was acquired by Westlake Chemical Corporation. It did a reverse split over a decade after I sold, and that's why the right scale shows such a high price. Let's talk about how I used gaps in this trade. I owned the stock and watched as price made a V-shaped top. At A, circled, the stock made a chart pattern called a narrow range 4. It says that the last price bar of the 4 is the shortest. Price gapped down out of the pattern in a breakaway gap. A day later, another gap appeared, an exhaustion gap. Here are my notes from the trade. 20 February 1998, 2 days ago, there was a narrow range 4 coupled with an inside day. Had I known about these, I might have sold it sooner, but I held on to today before I sold. This is now after a breakaway gap yesterday and an exhaustion gap today. I suspect that the decline is over. From here, I believe it will double top then decline. Volume is just too high to be sustainable. I received a fill at 821.88, which is just below the closing price on the day shown on the chart. The attempt at a second peak, a double top, never happened, but my prediction that the stock would continue down was correct. The stock hit bottom at 250 in late March 1999 for a drop of 70% below my sale price. I don't use gaps often in my trading, but this is an example of how I've used them in the past. Gaps have helped me exit stocks near the peak. The gap is an exit signal, but knowledge of the stock's fundamentals and technicals also helps time the exit and gives me confidence that the sell decision is correct. 37. Gartley, bearish. Results snapshot. Appearance. Looks like a big W with the turns located by Fibonacci ratios. The bearish Gartley is another pattern whose turns are governed by Fibonacci numbers. The actual numbers used for identification are open to debate. Your software may pick numbers different from the ones I chose. I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The results snapshot shows that the performance rank of the Gartley and bear markets is the best out of the 5 types of bearish Fibonacci-based patterns studied. The performance rank measures the average decline from the high at point D in the pattern, the end of the pattern, to the ultimate low, but only for those patterns reaching and turning down at D. Failure rates in bull markets are substantially higher than they are in bear markets. That makes sense when you consider the bullish market trend is fighting against the stock going down compared to giving the downtrend a swift kick in the pants in a bear market. If price makes it up to the calculated point D, there's an 87% to 89% chance price will turn lower. That's near the top of the food chain, so it's good. I'll discuss more numbers in the statistics section. Until then, let's take a tour of the pattern. Tour. Figure 37.1 shows a bearish Gartley at turns X, A, B, C, D. This Gartley appears in a longer-term downtrend that began in May 2018 from a high of just over $80. The pattern looks like a W from X to D, but it looks nicer on a more compact scale, smaller looking up and down wobbles. The pattern starts at peak X and ends at D, forming an Eve and Adam double bottom at AC that fails to see price rise much above peak B. The double bottom is not part of the Gartley, just an observation about this example. When the stock reaches the predicted price of 58.83 at D, which peaks at 59.32, the stock drops. It heads lower, dropping 25% to the ultimate low at E. The ultimate low is the lowest low after which price climbs more than 20% or closes above the top of the chart pattern X in this case. If you do the math for this pattern, we will know the price D is supposed to be. When it appears, let's say we short 2 days later, just to be safe that the stock has put in a top at D, filled at 55. We decide to sell after E put in a double bottom at about 48. The difference, $7 a share or 13%, is our profit. That's a reasonable expectation for this trade, and it shows the power of a Gartley. You may have been able to make more or less, depending on your trading skills and your courage. One last thing, volume trends downward as shown by line F. I know you've been waiting for me to say that, so tag you're it. Identification guidelines. Table 37.1 shows the identification guidelines for the bearish Gartley, and figure 37.2 provides an example for your viewing pleasure. Don't forget the popcorn. This bearish Gartley, which appears as turns X, A, B, C, D, shows a frequent anomaly found in the pattern. Notice how price dips after point D before moving higher to G. A visual examination of 100 bearish Gartleys shows this behavior happens 27% of the time. Sometimes the breakout is upward, meaning the rise to G sees price close above X. That's not the case in this example, though. Here, price breaks out downward at E when price closes a whisker below the low at A. If you had shorted the stock after D when price started moving lower and placed a tight stop a penny above the high at D, you would have been stopped out of the trade for a loss. And the stock would have rubbed salt into the loss when price dropped in a straight line run down to E. At E, the stock bounced off support and the bearish decline ended. For a time. The calculated D turn is at 168.45 for this pattern, so the stock overshot that price. Thus, if you went through the math and placed an order to short before checking if the stock actually turned there, you were making a mistake. Can't image anyone doing that, but you never know. Volume in this Gartley is typical for the pattern a downward trend, appearance. The pattern is named after its founder, H.M. Gartley. It looks like a big W with unequal bottoms, a pattern I call an ugly double bottom. I don't discuss ugly patterns in this book, but my website, the Pattern Site. Com has some details on a few patterns in case you're interested. Look for ugly patterns on the home page. The Bearish Gartley is a 5-turn pattern with several of the turns obeying Fibonacci numbers. At least modern versions of the pattern apply numbers to the turns. Depending on which source you check, the numbers may vary from source to source, as I mentioned. Table 37.1 shows the ones I used. Your pattern recognition software may use a different method and different Fibonacci numbers to qualify the Bearish Gartley. Here's how I identify the various turns in the pattern. BA/XA retrace. I select the first 2 turns, X and A, as a significant minor high and low, respectively. Then I look for turn B, which should create a 0.618 ratio of leg BA to XA. For figure 37.2, I use the high at X, 177.27, low at point A, 149.87, and the high-low range of the last point of the 3B at 167.32 to 164.82. The thinking here is that the high-low range of the price bar at B should encompass the 0.618 number. Looking for too narrow a window will reduce the pattern count, but may improve performance. Plugging the values into the ratio using the high at B, we get 0.64. Using the low at B, we get 0.55. Thus, the range of 0.55 to 0.64 encompasses the target 0.618 Fibonacci number. Turn B qualifies as valid. BC/BA retrace. I use the same method to find turn C, which has a high-low price of 159.55 to 151. I use the high at B, the low at A, and the high-low range at C, the last turn in the triplet. Plugging the numbers into the BC/BA ratio gives a range of 0.445 to 0.935. That range should include at least one of the numbers listed in Table 37.1 for this line item, and it does all except 0.382. Turn C is a good egg. DC/BC extension. Extensions use the same method as retraces. This time, we're trying to find point D, so that's the one I use the high-low price range on. D has a range of 171.71 to 168.50. Plugging them into the equation using the high at B, low at C, and the high-low range at D gives 1.07 to 1.27. That range includes 2 of the Fibonacci numbers listed in the table. Turn D is a valid part of the Gartley. DA/XA retrace. Finally, with the DA and XA retrace, I use a different method. I use the high at X, low at A, and high at D, but turn D must be within 3% of the target 0.786 number. Using the numbers in the formula gives 0.80, which is within 3% of 0.786. Volume. Volume trends downward between 65% and 71% of the time, according to research I did on the pattern. See Table 37.2 for more information. Duration. I limited Bearish Gartleys to no more than 6 months long. This is an arbitrary limit. Focus on failures. Figure 37.3 shows what I consider a failure of a Bearish Gartley. The Gartley is conveniently labeled XABCD in the figure. The idea behind a Bearish Gartley is to see price drop after D. When it doesn't, then that's a failure. For example, in the figure, price drops from peak D but not far to E, just 4% below D, before zipping up to F at the breakaway gap and staging an upward breakout. I show that breakout where price closes above the horizontal black line at F. Volume slopes downward from pattern start to end as G shows. I already mentioned the dip that appears after D 27% of the time, and this is another example of that behavior. Only this stock continues higher versus figure 37.2, which turns down at G. So shorting at D is a risk when trying to trade this pattern. In figure 37.3, notice the strong upward push from the lowest low on the chart in late December to the start of the pattern X. The Gartley acts as a measured move up, or ABC correction if you're an Elliott waver, with the drop from X to A being the corrective phase, followed by a resumption of the uptrend from A to the high on the chart. I know, the last leg doesn't rise far enough. The stock dips to 247 in December and peaks in February 2020 at nearly 307. Maybe the next time you see such a strong push higher, the straight line run from the December low to X, be cautious about taking a bearish position. There's an old saying that you should avoid shorting stocks making new highs, short those making new lows. The failure of this pattern to make a meaningful drop after turn D is an example. This bearish Gartley is bullish. Statistics. Table 37.2 shows general statistics for the bearish Gartley. Because the numbers highlight perfect trades, your trading results will vary. I focus on the move after turn D to gauge performance to the ultimate low. The ultimate low is the lowest low before price either climbs by 20% or closes above the top of the Gartley. Number found. I unearthed 2975 bearish Gartleys in 1,098 stocks, with them appearing from July 1991 to September 2019. Not all stocks covered the entire period, and some no longer trade. Break-even failure rate. This is a count of how often the stock fails to drop more than 5% below D. Notice that when the downward direction agrees with the bear market trend, the failure rate is tiny compared to other chart pattern types. In bull markets, where the turn down at D is met with a rising general market, the headwind keeps price from falling far. The bull market failure rate is huge compared to the bear market, about 3 times higher. That's a gale force headwind. Average decline after D. For swing traders, this is important. You'll want to know how far down the average pattern sends price. Again, the bear market drop outperforms the bull market drop by a wide margin, almost 2 to 1. I'll use a magnifying glass in the next table and take a closer look at these numbers. Volume trend performance. Volume trends downward on average at least 65% of the time. I checked the performance of Gartleys with up and down trending volume and did not see a significant performance difference. Trading tactics. As I mentioned, the thinking behind the bearish Gartley is not to burn your fingers out when using a calculator to find all of the turns, but the short after price peaks at D. How well does that work? Let's check some numbers, shown in table 37.3. How often does price turn at D? I found that price nearly always, 87% to 89% of the time, rises up to reach the calculated turn D. The two market numbers are close, too, which is reassuring. So you can know ahead of time at what price D will appear. Then you can wait with Snoopy for it to show, like what's his name in the pumpkin patch in the Charlie Brown series. After price turns, then you short. But how far down will the stock drop? How many drop to? For those patterns that do see price reach and turn at D, how far down does price drop? I use the pattern's turns to help gauge this. For example, turn B is closest to turn D, so you would expect a high rate of price reaching that turn. Indeed, nearly all of the patterns will drop to B. At the bottom of the pattern is point A. In bull markets, less than half, 34%, will see price drop that far. Bear markets do better with price reaching the bottom of the pattern 41% of the time, but that's still less than half the patterns. Clearly, you'll do better trading this pattern in bear markets than in bull ones. Now that you have the probabilities of price reaching one of the turns in the Gartley, you can pick your target. Let's read how George traded a Gartley. Sample trade. Figure 37.4 shows how George used a bearish Gartley to trade a stock. His software found the pattern for him at XABCD. He measured the rise from A to B, 43.56, 34.70, or 8.86. He added this to the low at C to get a target of 8.86 plus 35.73, or 44.59. Point D to K's high was 45.38, which is close to the predicted target. George calculated how long it would take price to rise to D. Using points A, 2 July 2010, B 27 July 2010, and C 24 August 2010 as references. He added the 25-day span of A, B to C to get 18 September 2010. Point D came close, peaking on September 30. This method was a way to calculate point D, given the ABC turns. The idea depends on the AB equals CD pattern working, where leg CD equals AB both in time and price. However, George doesn't like to short stocks. Too dangerous. Remember what happened to Joe Campbell. Joe had $37,000 in his brokerage and bet a $2 biotech stock would fall further. The next day, the stock surged to $16, wiping out his account and with the brokerage handing him a bill for an additional $106,000. George decided to trade this Gartley like a normal chart pattern. He measured the height of the Gartley from X 13.21. That gave him a target of 61.12 when he added the height to the price of the top of the Gartley, X. When price gapped higher breakaway gap at E and broke out upward closed above the price of X, he bought the stock long and received a fill at 47.59, the opening price the next day. He placed a stop at 43.21 or 9% below his purchase price. That's a few pennies below the minor low just after D, 2 days before the gap. He placed an order to sell if the stock reached the 61.12 target. Price continued moving higher and higher. At H, price formed a minor high. When it resumed its upward trend, gapping higher again, a breakaway gap above the peak at H, he raised his stop to K below the minor low. At F, the stock peaked at 60.73, close to his 61.12 target. But it closed down substantially, almost hitting his stop-loss order. He remained in his trade but became nervous. I should have sold near the peak. He pointed to his screen at F. Isn't hindsight wonderful? At I, the stock made a minor low. When it gapped higher, area gap, 2 days later, he raised his stop to 53.72, just below I. At J, the stock dropped to his stop and took him out of the trade. If he held on for a few more weeks, the stock would have hit his 61.12 target at G and taken him out for a larger profit. He bought at 47.59, sold at 53.72, and made 6.13 a share, 13%. Had he held on until price reached his target, he would have made 13.53 a share or 28%. The stock peaked at G, the ultimate high, at 61.45. After that, it dropped all the way down to 38 and change. 38, Gartley bullish. Results snapshot. Appearance. Looks like a big M with the turns located by Fibonacci ratios. The Bullish Gartley is another variation of Fibonacci patterns. This one looks like a big M with the right top slightly lower than the left. If I saw a twin peak pattern with a lower second peak, it would suggest the bulls were struggling to attain the height of the left peak and lost, and that would mean a larger decline. I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. Only compare these results with other Fibonacci patterns. Of the 5 bullish Fibonacci-based patterns I looked at, the Bullish Gartley in bull markets is the worst performer. The break-even failure rate in both bull and bear markets for this pattern ranks last worst. The reversal rate is very good, though, at 86% to 90% of the time. That means if you expect price to turn at the end of the pattern, there's a very good chance it will. To get a complete picture, let's see what a Bullish Gartley looks like and discuss some numbers. Tour, figure 38.1, shows an example of a Bullish Gartley that works like it's supposed to. The pattern begins at X, which some describe as a major turn. My collection of Gartleys accepted any wide minor low as the first turn. Following X is a peak, a minor high, shown as point A. Both X and A are consecutive but not necessarily adjacent turns. However, as the chart shows, there can be intervening peaks or valleys between the two. Point B is located at a Fibonacci retrace of the XA rise. I'll explain what that means in the next section. Additional turns follow C and D, with each turn determined by a Fibonacci number. Let me say that the actual Fibonacci numbers used is open to interpretation. I've seen numbers different from the ones I chose. Your software may use a different algorithm to find Gartleys, so keep that in mind. They may perform better, or worse. After price bottoms at D, it's supposed to move higher, which it does in this case by laying down a straight line run to E. Notice how peak E appears at overhead resistance set up by peak A. In this example, the stock retraces some, but eventually stages an upward breakout when price closes above the top of the pattern at F. So there you have it. The Gartley is at XABCD. Price climbs after D if the pattern is on its best behavior. Volume G trends lower most of the time like that shown. How do we actually find Gartleys? Here's a hint, don't look in the produce section. Identification guidelines. Table 38.1 shows identification guidelines similar to all Fibonacci patterns, and figure 38.2 shows another example of a bullish Gartley. How do I find Gartleys? Let me count the ways. Actually, I programmed my computer to do the counting for me. If you want a copy of my pattern finding software, visit my website at www.thepatternSite.com. You can download and use a copy for free without any registration process or annoying ads. It'll find a garden full of butterflies, bats, crabs, including those pesky neighbors, the Gartleys. Figure 38.2 shows a Gartley at XABCD. Price rises to F, hits overhead resistance and fades, falling to G. Neither F nor G are outside the XA height, so a breakout hasn't happened at those turns. However, price rebounds to H, where an upward breakout happens, and price works its way higher after that, for a time anyway. Volume in this example trends upward, which is unusual for a bullish Gartley despite what you may have heard on the cocktail circuit. Appearance. The pattern looks like a big M or double top with the right peak C lower than the left A, sometimes by a substantial amount. You might think of it as an ugly double top. See my website for details. A, B, and A, X retrace. Turn B is located by calculating the retrace of the move up from X. To do this, I use the low price at X 31.49, the high price at point A 37.06, and the high-low price range at the target B 33.83 to 33.20. Plugging the numbers into the formula using the high price at B, we get 0.58. Using the low price at B, we get 0.69. The range of 0.58 to 0.69 encompasses the target 0.618, so point B qualifies as the first Fibonacci turn in the Gartley. CB/AB retrace. Find turn C in the same manner. I use the high price at A, the low at B, and the high-low range of target C, 36.38 to 35.02. Plugging the numbers into the ratio gives a range of 0.47 to 0.82. That range includes 4 Fibonacci numbers listed in Table 38.1. Any one of them will do just fine. Thank you very much. So point C qualifies as a valid turn also. CD/CB extension. Calculate an extension in the same way as a retrace. In this case, I use the low at B, high at C, and the high-low range at D, 34.10 to 32.66, to get a range of 0.72 to 1.17. The 1.13 Fibonacci number squeaks into the range, so point D qualifies. We've one more ratio to calculate before we pronounce this a valid Gartley. AD/AX retrace. For the last ratio, leg AD as a retrace of AX, I use the low at X, high at A, and low at D. Notice I don't use the high-low range at D. Rather, turn D must fall within a 3% window. Why? I wanted the last turn to be almost dead on. In this example, point D comes in at 0.79, which squeezes through the 3% of 0.786 window easily. Passing that last ratio test means this pattern is a valid Gartley. However, one source I checked said that the height of leg CD should be a Fibonacci number of AB, so that it acts like an AB equals CD pattern. You can add that test to see if performance improves. Volume. We'll see in Table 38.2 that volume trends downward 62% of the time. Figure 38.2 shows an exception when volume E trends upward. To determine the volume trend, I checked the slope of a line found using linear regression. Often, you can just look at volume and see how it's trending. Don't let the volume trend prevent you from trading a Gartley or most other chart pattern types. You'll discover then the volume is a poor indicator of future performance. Duration. The pattern has no maximum duration, but I set a limit of about 6 months for the patterns I cataloged. Focus on failures. Figure 38.3 shows a classic example of a bullish Gartley failure. The Gartley is at XABCD with volume trending downward G. After turn D, the stock is supposed to rise. It does, but only to E in this case. If you bought long at the open on that day with a stop a penny or two below D, you'd have been stopped out when price stumbled on the way to F. Looking at this pattern from X to F, notice that F bottoms near the price of X. I call X the launch price, and you sometimes see a reversal pattern that sends the stock back down like the one shown here. The stock will bottom near the price of X, often slightly higher than X. It doesn't happen that often, but such behavior, not just for Gartleys, but for all chart pattern types, can help you determine how far price might drop. It also might give you a buying opportunity when the stock turns upward at F. Notice the inverted roof type pattern from May to October, and even a diamond bottom hiding in the middle of it, as shown. When I see a breakdown from this type of horizontal top, and a bullish pattern emerges afterward, just as the Gartley does here, I know it's a disaster waiting to spring on the bulls. The pattern invariably fails and down price goes. Learn from this example and don't go long after the breakdown from a horizontal topping pattern. Statistics. Table 38.2 shows general statistics for the bullish Gartley. Number found. Gartleys were plentiful, especially in bull markets. The bear markets, 2 of them, were shorter than the bull markets, so you'd expect to see fewer patterns. However, and this was a quick calculation, more Gartleys appear in bear markets than in bull markets when adjusted for the time involved. Break-even failure rate. I counted the number of times a bullish Gartley saw price rise less than or equal to 5% on the way to the ultimate high. It's odd that bear markets have lower failure rates than bull markets. Bull markets see price climb, helped along by the general market. Bear markets see price rise in a falling market. I would expect that when price struggles against a headwind, such as in bear markets, it wouldn't rise as far, meaning more failures, but that's not what happens. Average rise after D. I measured the average rise for Gartleys from the low at D to the ultimate high. Patterns in bull markets performed better than did those in bear markets. That makes sense. Volume trend, performance. I used linear regression to determine the volume trend from the start of the pattern to the end. Volume trends downward most often. I checked if performance was better when volume sloped upward or downward, and there's not much of a difference in bull markets. Bear markets give the performance edge to those patterns having a downward volume trend. Trading tactics. The idea behind the bullish Gartley is that once the pattern completes at D, the stock will turn upward. Because you can do the math and calculate where D is going to be, you can anticipate the turn. We'll see in a moment that 86% to 90% of Gartleys turn upward at D, so be patient and see if D forms where you expect. When it's clear that the stock has found a bottom at D or is making its move higher, then buy the stock. Ride it upward. Table 38.3 provides guidance on how far price might climb, based on the Gartley turns. Table 38.3 shows numbers important to swing traders. How often does price turn at D? If price makes it down to D, does it turn there? Yes, and almost all of the time, 86% or higher. Thus, you can depend on a Gartley seeing a reversal at D. Of course, even for a pattern with a high reversal rate, that says nothing about how far price will trend upward after D. How many rise to? For those turning upward at D, I mapped how often the stock climbed to the price of one of the turns. For example, point B is closest to turn D, and we see that nearly all of the time price will climb up to the price of B. The top of the pattern is at turn A. The stock only reaches the price of a less than half the time bull markets and less than a third of the time in bear markets. Hopefully, you can use these statistics to help decide if a Gartley is worth trading. Your situation may be different, and other indicators may help you select patterns that will outperform. Sample trade. My brother called last night and we chatted about stocks. His holding in Netflix jumped upward on good quarterly numbers. How should I trade it? He asked. In about a week to 10 days, it'll peak. Sell it then. That's what I told him. It reminds me of a trade Jacob made. See figure 38.4. Jacob's computer flagged the Gartley XABCD and showed him where turn D was expected to appear. Looking to the left of point D, he saw points B and E were near the same price. That's support, he told me. Except for the plunge at X, the rest of the pattern ebbed seemed to be resting on a flat table. 2 days after the stock reached D, I bought at the open at 8.51. He set a target for the top of the pattern, 10.53, which is a few pennies below the low price at A. Not above the high at A because he wanted to sell in the resistance area, not hope price would rise above a peak. Because this was a short-term swing trade, he placed a stop-loss order a few pennies below D at 8.23 with his broker. The stock worked its way higher for a week and then took off, making a large one-day price jump. The stock blew through his target, but fortunately, he didn't place a sell order with his broker. I like to pick my exits. When a stock makes a sharp move higher, as I mentioned, it often crests in a week to 10 days. He counted down, and 1 calendar week after the big move G, I sold the stock at the open H at 12.05 for a gain of 3.82 or 46% in about 2 weeks. Nice. For a swing trade, he did exceptionally well. He bought near the low and missed selling at the peak by a few days too late. Obviously, for a longer-term hold, he sold way too early. The stock drifted down for a month but then continued higher. The rise at G was earnings-related. The company announced first-quarter results. Notice the trend, how price peaks quickly, 7-10 days, retraces for a month, and then moves higher at a more sedate pace over many months. You may notice this behavior in other stocks related to the announcement of surprisingly good earnings. They can make for profitable trades, both swing trades like Jacobs and longer-term holds. 39. Head and shoulders bottoms. Results snapshot. Appearance: 3 valley pattern with center valley lower than the others so that the pattern resembles an inverted head and shoulders bust. I find it easier to pick tops rather than bottom patterns. Perhaps this is because I spend so much time worrying about when to sell. Placing a trade is easy, getting out for a profit is the tough part. In my quest to sell at the appropriate time, I have often overlooked the buy side, bottom reversals. Head and shoulders bottoms are just such a pattern. They are quite easy to spot and can be profitable. The results snapshot highlights statistics for this bullish reversal. The performance rank is good but not outstanding. The head and shoulders pattern has a low break-even failure rate and a nice average rise. Volume trends downward between the two shoulders, and that's typical for many chart patterns. Throwbacks occur in 2 of every 3 patterns. Again, that's typical. In fact, I don't see anything unusual with the numbers. Grab your bag lunch and let's start the tour. What does the chart pattern look like? Figure 39.1 shows an example of a head and shoulders bottom. The stock peaks during February where the chart begins. From that point, the stock moves downward and makes a lower low in late March before moving up. The turn forms the left shoulder. The stock declines again and reaches a new low during late April, creating the head. The right shoulder appears as the stock recovers, and then continues moving down along the trend line, shown in the figure as the neckline. By mid-August 1995, not shown, the stock is trading just below 60. This head and shoulders bottom has a typical volume pattern. Volume is usually highest on the head, then the left shoulder, and even lower on the right shoulder. This head and shoulders pattern shows little increase in volume during the rise from the head to the right shoulder. Volume on the breakout is unexciting, and that helps explain why the stock stalls. Upward momentum fails to carry price much higher. The stock rounds over and heads back down through June. Figure 39.2 shows a head and shoulders pattern on a weekly scale. I chose this chart to show you the typical trend of head and shoulders bottom reversal. It usually forms after an extended price downtrend. As a reversal, once the chart pattern completes, price rises. Why do head and shoulders form? The chart pattern represents a struggle to find the bottom, the lowest price that represents the best value. As the stock descends during the winter of 1993, investors nibble at the stock in increasing numbers. Volume climbs even as the stock descends, until it spikes upward for 1 week during formation of the left shoulder. Buying demand puts a crimp on the downward slide, and price moves up but only for a week. The following week, price moves lower. Again, volume spikes as the stock makes a new low, and this becomes the head. The smart money is accumulating the stock in anticipation of an eventual rise or a change in the fundamentals. The stock moves up on receding volume, then retreats and forms the right shoulder. Volume on the 3 valleys is diminishing. The left shoulder has very high volume, the head exhibits somewhat less volume, and the right shoulder records the lowest volume of the 3 valleys. Only after price starts moving up from the right shoulder does volume spike upward. Breakout volume is unconvincing. In late August 1994, price moves decidedly above the neckline and stages a definitive breakout. Even so, it is not until 2 weeks later that volume advances noticeably. Identification guidelines. Table 39.1 encapsulates the identification guidelines for head and shoulders. Consider figure 39.3, a handsome head and shoulders bottom on the daily chart. This example of a head and shoulders does not appear at the end of a long-term downtrend, but at a short-term one up to 3 months. The pattern reverses the downtrend, but continues the long-term uptrend, acting like the corrective phase of a measured move-up chart pattern. Appearance. Overall, the pattern sports the 3 telltale valleys, left shoulder, head, and right shoulder. The left shoulder is at about the same price level as the right one and appears to be about the same width. Such symmetry is common in head and shoulders patterns, tops, bottoms, and the complex variety. If the left shoulder is sharp or pointed, the right shoulder will be too, but be flexible in your assessment. I don't pay attention to shoulder shape. The head is below both shoulders by a reasonable amount. By this characteristic, I mean the pattern is not a triple bottom, 3 valleys at about the same price level. The head should be proportional to the shoulders. Consider discarding a pattern with an unusually tall neck or shoulders too uneven to be healthy. In the figure, the left shoulder sees price decline for 3 days, reverses, and climbs to a minor high. Similarly, the rise between the head and right shoulder climbs almost to the height of the rise between the left shoulder and head, then descends to the right shoulder. All 5 features, the 3 valleys and 2 minor rises, appear well defined and distinct. The features are important as you scan your charts looking for head and shoulders bottoms. Symmetry. Symmetry is another important key to selecting a valid head and shoulders bottom. The right side of the pattern usually mimics the left side. The right shoulder declines to about the price level of the left shoulder, and the distances of both from the head are similar. Of course, there are many variations, but symmetry should make a head and shoulders bottom stand out from a sequence of any 3 depressions. Volume. Volume represents another clue to the validity of a bottom. The left shoulder or head has the highest volume, with diminished volume on the right shoulder. Breakout volume is usually high as it pushes price above the neckline. As a general guideline, volume will rise on the day of the breakout, but it need not. Don't discard a pattern because it has an unusual volume pattern. Neckline. The neckline is an imaginary line connecting the 2 rises between the shoulders and the head. It can slope downward, upward, or be horizontal. In well-formed patterns, the slope of the line is not very steep, but a steep neckline should not be a disqualifier of a head and shoulders bottom. Figure 39.1 has a rather steep neckline. Breakout direction. When price closes above a down-sloping trend line or above the right armpit, the highest high between the head and right shoulder, that occurrence signals an upward breakout. Use the right armpit as the breakout price instead of an upsloping neckline because you may get a buy signal sooner. You may never get a signal in a head and shoulders bottom with a steep upsloping neckline. Confirmation. The pattern confirms as valid when price closes above the neckline or right armpit. If price closes below the head, then it's not a head and shoulders bottom. Focus on failures. Head and shoulders bottoms have 2 types of failures. The first type, shown in figure 39.4, is a failure of the head and shoulders bottom to pierce the neckline and move higher. As you would expect, the chart pattern appears in a downward price trend. The highest price peak is partly visible in the upper left corner of the figure. From the high of 38.75, price falls to the low at the head, 21.25, a decline of 45%. When the bottom forms, it should signal a trend reversal. An interesting thing about this example is that the left shoulder is almost the same shape as the right. Only $1 separates the 2 shoulder lows, and the head is well below both shoulder valleys. The right shoulder is somewhat farther away from the head than the left. This characteristic is typical. Volume is suspiciously low throughout the pattern. The left shoulder and head register about the same level of volume. The right shoulder volume, however, is higher than the other 2. Of course, an irregular volume pattern is no reason to discard a chart pattern, but it is a warning signal. After the right shoulder forms and price begins rising, volume tapers off rapidly, and the attempt to pierce the neckline fails. The rally attempt does not even come close to the neckline. Looking at the overall chart pattern, there is no one item that signals an impending failure. There is some suspicious activity, principally the abnormal volume pattern, but nothing to deter an investor. Figure 39.5 shows a slightly different type of failure. This is what I call a 5% failure. The 2 shoulders and head appear well formed and distinct. The left shoulder looks different from the right, but the twin rises between the shoulders' armpits look similar. The price level of the two shoulders is not suspiciously out of line. Volume is unusual. Heavy volume appears near the head as price rises away from it toward the right shoulder. The right shoulder volume looks like something you would want to tackle with your shaver. Annoying but not high enough to be alarming. Price advances smartly after the right shoulder bottom forms and then moves sideways for 2 weeks before starting back down. Although this example does have an upward breakout, price fails to rise by more than 5% above the neckline. Price should reach 39.38 to meet the 5% threshold, but does not. The result is a failure of the 5% rule. Price must rise by more than 5% after a breakout or the chart pattern is a dud. Statistics. Table 39.2 shows general statistics. Number found. I found the first head and shoulders in July 1991 and the last in December 2019 in 1,036 stocks, giving me 3832 patterns. Not all stocks covered the entire period and some no longer trade. Reversal R, continuation C occurrence. By definition, head and shoulders bottoms act as reversals of the prevailing downward price trend. Average rise. In bull markets, the average rise is above the 42.4% average in bull markets and ties the 28% rate in bear markets. Standard & Poor's 500 change. The general market rise helps push price higher in bull markets, but doesn't offer much assistance in bear markets. Notice, though, how the average rise for the head and shoulders bottom wallops the S&P rise, even though both use the same date's breakout to ultimate high. Days to ultimate high. Price climbs 1.6 times faster in bear markets. I found this by taking the ratio of 45% rise in 227 days compared to a rise of 28% in 91 days. That is an interesting finding if you happen to be in a bear market. Although the average rise will not be as large, price will top out sooner, allowing you to trade more often. How many change trend? This is a count of how many patterns see price rise more than 20% after the breakout. A higher number is better. I like to see values above 50% and the bull market does very well. The bear market comes close too. So the head and shoulders bottom is a good performer. Table 39.3 shows failure rates. I found that 11% of the patterns in bull markets fail to see price rise more than 5%. The failure rate doubles to 22% for patterns failing to rise more than 10%. Ouch. It almost triples the break-even rate for failures to rise more than 15%. Yikes. Bear markets show a steeper progression, from 9% to 29% to 42%. In bull markets, the median failure rate is 27.5% and in bear markets, it's 18.7%. Table 39.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is always upward. If price closes below the head first, then you don't have a head and shoulders bottom. In fact, a close below the right shoulder would make the pattern look weird too. However, it might be forming a complex head and shoulders bottom. Yearly position, performance. Head and shoulders patterns in bull markets do not show a significant performance difference depending on where in the yearly high-low price range the breakout resides. The numbers say the middle third perform best. In bear markets, those near the yearly low do best. Throwbacks. Throwbacks occur 2/3 of the time, and when they do happen, it takes about 11 or 12 days for the stock to return to the breakout price. If a throwback occurs, performance suffers. However, price resumes the upward trend between 65% and 75% of the time. Gaps. Does a gap on the breakout day indicate better performance? Yes, head and shoulders bottoms with a breakout gap perform better than do those without a gap. I use the opening price the day after the gap in the measure to the ultimate high, so you can participate in the better performance of patterns with gaps by buying after the gap appears. Table 39.5 shows size statistics for the head and shoulders pattern. Height. Most chart patterns perform best when the pattern is taller than the median, and the head and shoulders is no exception. In bear markets, for example, tall patterns see price rise an average of 32%, but short ones rise just 24%. I measured height from the highest high to the lowest low in the pattern, then divided by the breakout price, so I was comparing apples to apples. Width. The results for width are not consistent across market conditions. Bull markets show wide patterns leading to better performance, and bear markets show narrow ones outperforming. I use the median length to separate narrow from wide patterns. Height and width combinations. I looked at the combinations of height and width and found that patterns both tall and wide do well in bull markets. Bear markets prefer tall and narrow patterns. The worst performers are short patterns, but check the tables for actual numbers because they vary for different market conditions. Table 39.6 shows volume-related statistics. Volume trend. Volume trends downward most of the time. Again, don't throw away a pattern just because it has an unusual volume trend. Rising/falling volume. I didn't see any performance difference for rising or falling volume in bull markets. Bear markets do better if volume is rising from shoulder to shoulder. Breakout day volume. Does high breakout volume guarantee better performance? No, at least not in bull markets. In bear markets, those with heavy breakout volume performed better than did those with light breakout day volume. Table 39.7 shows how often price reached a stop location, but my computer doesn't tabulate them correctly for this pattern, so I don't show the table. Table 39.8 shows the performance over 3 decades, performance over time. This pattern performed best in the 2000s and worst in the 2010s, but the performance differences are minor. Seeing a pattern with stable performance over time is as refreshing as sipping ice water on a hot day. Failures over time. Failures have tripled since the 1990s, which is an alarming trend if it continues. Table 39.9 shows busted pattern performance. Busted patterns count. I consider the busted count low for this chart pattern. Busted occurrence. Most of the time the pattern will single bust, but double busts in bull markets are close behind. In bear markets, nearly all of the busted patterns are single busted ones. Busted and non-busted performance. I use the head and shoulders top as the proxy for a non-busted head and shoulders bottom. In bull markets, single busted patterns outperform the other 2 benchmarks, but in bear markets, they don't do as well as a head and shoulders top pattern. Trading tactics. Table 39.10 shows trading tactics. Measure rule targets. Use the measure rule to set a target to help gauge how far price might rise. In figure 39.6, the head marks the lowest price in the chart pattern. Subtract the height from the value of the neckline directly above. In this example, the head has a daily low price of 13.13 and the neckline, measured vertically, is at 17.50. Add the difference, 4.37, to the breakout price. A breakout occurs on 28 March. I use its opening price the next day as the breakout price, 15.88, to get a target price of 20.25. Price reaches the target in early September. The lower portion of the table shows how often the measure rule target works using varying heights in the computation. The full height, as I used in the above example, works between 51% and 71% of the time, depending on market conditions, bull or bear. Cut the height in half and the measure rule works better, but the potential profit is less. Use a taller height, and the rule won't work as often, but when it does, you have the opportunity to make more. Once you know how far price might rise, check table 39.3 to see if it's realistic. In our example, the target is 4.37 away in a stock trading at 15.88 for a value of 27.5%. Table 39.3 says that 50% interpolating between 25% and 30% of the patterns in bull markets will fail to see price rise more than 27.5%. That's a high failure rate. Wait for confirmation. Wait for price to close above a down-sloping neckline or above the right armpit before trading. That is always the safe play. If you don't wait for confirmation, there's a chance price will break out downward instead of upward. Watch for throwback. Since a throwback occurs frequently, see table 39.4. If you miss the breakout, you may have another chance to invest or trade the pattern. Once price resumes its upward trend after the throwback completes. Table 39.11 shows special features of the head and shoulders pattern. However, I don't include bear market statistics because they show no performance advantage. Neckline slope. Head and shoulders patterns with down-sloping necklines performed slightly better than up-sloping ones. Shoulder lows. Left shoulder above right. I am comparing the lowest price in each shoulder. When the left shoulder bottomed above the right, the average rise after the breakout was 43%. When the left shoulder bottomed below the right, performance improved to 47%. Experience. I have traded this chart pattern a lot over the decades. I looked through most of my trades and found these common elements. Do buy in early at the breakout and not much later. Place a buy stop at the neckline or right armpit. That means you get in on time at the breakout. If the breakout has already happened, then wait for a throwback for a better entry price. Don't attempt to buy before confirmation. You'll likely suffer a loss when the pattern doesn't confirm. I tried this a few times and made a significant amount of money, but it's risky. 5% failures happen fast, usually in a week or two. Do place a stop below the right shoulder low. That will act as a tourniquet and stop the bleeding. Price moves up for about 2 months, but this range varies from 1 month to 3 months. That's the time to exit a swing trade. It likely won't be the ultimate high, but there seems to be a pattern to this, where price spikes 2 months after the breakout. In 8 trades, 5 of them peaked in 2 months, 2 in 1 month and 1 in 3 months. If the stock looks to be peaking around the 2 months mark, then do your research and see if it's time to exit with a profit. Sample trade. Some people might consider Bob unlucky, but he has an adoring wife and 2 children. Employed as a blue-collar worker in a nearby auto plant, he is happy when he is working. Unfortunately, strikes by the union have taken their toll on his savings, and he has been looking for ways to supplement his income. Ever since I was a boy, I've been fascinated by Wall Street. I wanted to play the stock market, and when I saw the head and shoulders bottom pictured in figure 39.6, I took the plunge. He bought the stock at $16, the day after price pushed through the neckline. For over a week, the stock did fine. Price slowly moved up and reached a high of 16.63, then reversed. The stock threw back to the neckline and continued lower. Suddenly, he was losing money. Should I sell and take a loss or hang on because I knew the stock was going higher? That question kept me awake at night. He decided to tough it out. The stock bottomed at 14.50 and quickly recovered. It reached a higher high and then moved sideways for over a month, drifting slightly lower. I wasn't worried because I was making money now, not a lot, but some. I was sleeping better too. During the summer, things heated up for the airline and the stock took off. Almost on a daily basis, it flew higher, making new highs. A bearish, broadening top appeared, but Bob did not know about such things. He felt giddy in the thin atmosphere in which the stock was flying. The stock entered the clouds at 21.38. When the airline stock hit turbulence in mid-September and headed for the ground, I couldn't believe it. All I could do was watch my profit spin lower like the stock's altimeter. So I talked it over with my wife and we decided to hold on. It'll come back to its old high, and when it does, I'll sell it. The stock continued down. Soon, his profits gone, he was posting losses. He maintained his firm stance that he would not sell until the price climbed back to the old level. During October, things changed, not shown. The stock pulled up just before nosing into the ground at 13.63 and not only leveled out, but started climbing again. In a month, he was at breakeven. At the start of the new year, a descending broadening wedge took price lower as it widened but turned out to be a bullish omen. In mid-January, on unremarkable volume, the stock turned the corner. Volume climbed, helping price reach a higher altitude. As the stock closed in on his target of 21.38, I called my broker and placed an order to sell at 21.38. In late February, the stock began a straight line run. It soared through 21.38, hitting his sell order but kept climbing. In just over a month, it reached 30. Bob blushed and admitted, "I no longer invest in stocks." 40. Head and shoulders bottoms, complex. Result snapshot. Appearance. An inverted head and shoulders pattern with multiple heads, multiple shoulders, or both. I find that a complex head and shoulders bottom, which I refer to as a complex bottom in this chapter, is more difficult to recognize than a normal head and shoulders bottom, but not alarmingly so. If you can locate a normal head and shoulders bottom, then there is a decent chance that you are also looking at a complex one. If you look to the left and right of the 2 shoulders, you might see additional shoulders. Multiple shoulders are one indication of a complex bottom. Before I delve too far into pattern recognition, let me review the important snapshot statistics. The complex head and shoulders bottom is a strong performer with a low break-even failure rate, ranking 3rd out of 39 in bull markets, when a rank of 1 has the lowest failure rate, and a very good average gain after the breakout. Volume typically slopes downward, and about 2/3 of patterns have throwbacks to the breakout price. Let's see what these chart patterns look like. Tour. There are two types of complex head and shoulders bottoms, those with multiple shoulders and those with multiple heads. I can't recall seeing a head and shoulders bottom with multiple heads and multiple shoulders, but I'm sure they exist. Consider the chart in Figure 40.1, which shows a complex bottom. The chart pattern has two left shoulders, a single head, and two right shoulders. If you were scanning your charts for normal head and shoulders bottoms, this one would probably pop up on your radar. The left and right shoulders are well defined, and the head is below them. As you widen your view, you see an additional pair of shoulders. The left shoulder is about the same distance from the head as the right one. The two outermost shoulders are near the same price level too. Looking at all the shoulders and the head together, the chart is a good example of a complex head and shoulders bottom. However, the volume pattern is unusual because it is heavier on the right than on the left. Most of the time, the left shoulders show higher volume than the right ones. If you ignore the various labels, you can see a rounding bottom. The gentle turn of price, if you connect the minor lows, supports a bottom pattern. However you choose to classify this pattern, the bullish reversal is clear. A throwback appears in March when the stock returns to the neckline. Although it takes a week or two before price really begins moving up, the stock climbs to a high of 32.63 before retracing its gains. Compare Figure 40.1 with Figure 40.2, a complex bottom with two heads. Overall, the chart pattern is quite symmetrical. There are two shoulders and two heads. A neckline connects the highs in the pattern and projects forward in time until price closes above it. The penetration of the neckline is the breakout point. Notice how flat, almost horizontal, the neckline appears. A near horizontal neckline is a feature you can look for when prospecting for complex head and shoulders bottoms. The regular head and shoulders tend to have steeper necklines than the complex variety. Figure 40.1 also shows a horizontal neckline. In Figure 40.2, the breakout in mid-November quickly throws back to the neckline, and price moves lower for a week or two. This is not a good example of a throwback, because price didn't rise far enough to show white space between the stock and the neckline. Figure 40.1 shows a better example of a throwback where price lifts off, curls around, and returns to the neckline, leaving behind a white hole inside the looping price movement. In Figure 40.2, by late March the stock reached a high of 16.63, well above the head low of 9.19. Volume on the left side of the chart pattern is heavier than on the right. In this regard, the pattern is more typical than that shown in Figure 40.1. Identification guidelines. Are there certain characteristics that make complex bottoms easy to identify? Yes, and I outline them in Table 40.1. Appearance. As discussed before, there are two general types of complex head and shoulders bottoms, those with multiple shoulders and those with multiple heads. Rarely do you have both. Figure 40.3 shows a complex bottom with multiple shoulders. The head is slightly below the shoulders but far enough below to distinguish the chart pattern from a triple bottom. Symmetry. In this case, there is a normal head and shoulders bottom flanked by an additional pair of shoulders. The overall pattern appears symmetrical. The two left shoulders match the two on the right in distance. In this example, the two right shoulders are higher than their corresponding left ones. However, do look for symmetry between the shoulders, both in time and price. Volume. The figure shows the typical volume pattern. The two left shoulders show higher volume than the two right ones. Overall, volume recedes over the length of the chart pattern, near horizontal neckline. The neckline connects the highest peak to the left of the head S with the highest peak to the right of the head S. Most of the time the neckline is horizontal or nearly so. Many of the patterns shown in this chapter have near horizontal necklines. If you see a steep neckline, then recheck your work to make sure you're looking at a valid complex bottom. Breakout direction. For those patterns with upsloping necklines, use the highest high on the right side of the head S in the complex bottom as the breakout price. Using a steep upsloping neckline to gauge the breakout means price may never close above the neckline, or price will rise too far to trigger an entry. For down-sloping necklines, a close above the neckline signals a breakout. If price closes below the bottom of the pattern before breaking out upward, then it invalidates the pattern. Head and shoulders bottom patterns do not break out downward. Quite often, price throws back to the neckline and perhaps moves lower before resuming the upward trend. Figure 40.2 shows an example of this behavior during November and even in late December. The December move saw price plunge from a high of 11.50 to 9.44, a decline of almost 20% in just 2 days. When the decline ended, price recovered quickly. Confirmation: price must break out upward. If it does not, then you don't have a complex head and shoulders bottom. Focus on failures. If making money in the stock market is important to you, it pays to study your failures. The lessons learned will serve you for many years. When you look at your failures as a group, you may begin to see trends. Figure 40.4 shows a typical failure of a complex bottom to reverse the downtrend. After the head and shoulders completed, price did climb, but only to 57.13. Price inched above the neckline and closed there for just a handful of days before sliding below the neckline in early March. Ultimately, the stock reached 40.63 in August, not shown. The left shoulder showed tremendous volume. Volume diminished at the dual heads, and the right shoulder showed even less volume. Breakout volume was anemic and may explain why the pattern failed. If price fails to rise more than 5% after the breakout, before closing below the bottom of the complex bottom, then it's a failure. Figure 40.4, for example, is a 5% failure. The breakout was upward, but price failed to climb far before reversing direction. Once price closed below the head, I knew that there was no hope and marked the pattern a failure. I found no reliable clues that would indicate an eventual failure of a complex head and shoulders bottom. Statistics. Table 40.2 shows general statistics. Number found. I found 1196 patterns in 667 stocks starting from July 1991 to October 2019. Not all stocks covered the entire period, and some no longer trade. Reversal R, continuation C occurrence. Complex bottoms have price dropping into the pattern and rising out of it, so all of them act as reversals. Average rise. The average rise in bull markets is 47%, a good showing, which is why the pattern ranks as high as it does, 9 out of 39. In bear markets, when price breaks out upward, the move is like swimming against the current, and the rise averages less, 32%. However, both numbers are above the average of all chart pattern types. Standard and Poor's 500 change. In bull markets, a big showing by the S&P helped stocks climb. In bear markets, the help was almost negligible. Using the dates of the breakout to the ultimate high of the complex bottom, the rise in the index falls far short of the move in the chart pattern. Days to ultimate high. It took almost 3 times as long for price to reach the ultimate high in bull markets than in bear markets. When you compute the velocity, 47% rise in 278 days versus a rise of 32% in 96 days. We see that the bear market rise is twice as fast as the bull market one. How many change trend? This table row is a count of how many patterns see price climb more than 20% after the breakout. I consider values above 50% to be good. The bull market certainly exceeds that, and the bear market almost does. Nice job, guys. Table 40.3 shows failure rates. As far as failures go, complex bottoms keep them small. Between 7% bull market and 12% bear market of the patterns, I looked at failed to rise more than 5%, the break-even rate. Half the patterns failed to rise more than about 30% after bull market breakouts, 20% in bear markets. As you scan down the columns, notice how quickly the failure rate climbs as the maximum price rise increases. In bull markets, at the 10% maximum price rise, the failure rate is 20%, almost triple the prior row. For the 15% price rise level, the failure rate is more than 4 times the break-even rate. How is this information useful? Imagine that the measure rule predicts a rise to 37.50 from 30, a climb of 7.5 points or 25%. In bull markets, we see that 43% of complex bottoms will fail to see price exceed a 25% rise. In bear markets, it's even worse, with 62% failing to exceed the target. Such big failure rates may make you adjust your expectations. Table 40.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is always up. If price breaks out downward first by closing below the bottom of the pattern, then it's not a valid complex bottom. Yearly position performance. The best performing complex bottoms vary depending on market conditions. In bull markets, for example, the best performing break out in the middle third of the yearly high-low price range. In bear markets, those within a third of the yearly low do best. I think the bull market results are suspicious. Rarely do patterns in the middle range perform well, but complex bottoms show an exception. Throwbacks. A throwback occurs in about 2/3 of the complex bottoms. Price breaks out upward, peaks in an average of 6 days, and returns to the breakout price for a round trip of 12 days. When a throwback occurs, performance suffers. That may surprise you, but it is common for chart patterns. My thinking is that a throwback robs upward momentum. The key is to search for overhead resistance before trading and to avoid it when possible. After a throwback completes, price resumes rising most of the time. Gaps. A gap that occurs during the breakout tends to push price higher, but only in bull markets. In bear markets, the results reverse, with complex bottoms without gaps showing better performance. Table 40.5 shows pattern size statistics. Height. Tall patterns perform better than short ones. I measured the height of patterns from the highest peak to the lowest valley and divided by their respective breakout prices. Values above the median saw better performance than did those below the median. Width. Width is not as good a predictor of future performance as height. The table shows that the results vary depending on whether it's a bull or bear market. To determine whether a pattern was narrow or wide, I compared it to the median width, height, and width combinations. Performance of the combinations of height and width tracks the results found earlier. By that, I mean bull market patterns that performed best when tall and best when wide saw the best performance if the complex bottom was both tall and wide. Similarly, bear market patterns show the best performance if they are both tall and narrow, matching their individual traits of height and width. Want to avoid trading short and narrow patterns in bull markets and short and wide ones in bear markets. Table 40.6 shows volume-related statistics. Volume trend. I found volume trends downward using linear regression on volume from the leftmost shoulder to the rightmost one. Rising and falling volume. Patterns with a rising volume trend outperform those with a falling volume trend. Breakout day volume. Both bull and bear markets show better performance when the breakout occurs on heavy volume, above the 30-day average. I don't show table 40.7 because I haven't taught my computer how to estimate it for this chart pattern. Table 40.8 shows the performance over 3 decades. I don't include bear markets because they happened in the 2000s only. Performance over time. Performance of the complex bottom has improved over the decades. This is one of the few times I've seen a consistent performance improvement over the years. Failures over time. Failures peaked in the 2000s, but I don't know why that is. Table 40.9 shows busted pattern performance. Busted patterns count. Few complex bottoms bust, which is good news if you buy long and expect price to continue rising. Busted occurrence. I sorted busted patterns into their types, single, double, and more than 2 busts, triple plus. Most of the patterns will single bust with double busts placing second. That may sound obvious and logical, but I've seen a number of chart patterns with triple plus placing second. Busted and non-busted performance. I compare the performance of busted patterns with complex head and shoulders tops as a proxy for non-busted complex bottoms. Single busted patterns outperform the others I tested. The catch to this is that you have to be lucky enough to trade a single busted pattern and not some other type double or triple plus. Trading tactics. Table 40.10 shows trading tactics. Measure rule, targets. The measure rule sets a target for price to reach and is best explained by an example. Figure 41.5 shows a complex head and shoulders bottom on the weekly scale with the head reaching a low of 13.50. Directly above that point, the neckline has a value of 18.63. The difference, 5.13, is the formation height. Add the difference to the breakout price, 17, to get the target, 22.13. The chart shows a complex head and shoulders bottom that forms after nearly a 2-year run-up in price. The formation marks a reversal of the 6-month retrace. It took price just 2 weeks after the breakout to reach the target, but the stock was not done climbing. It moved sideways for almost a year before continuing higher. The stock reached a high of 39.38, nearly triple the head low of 13.50, and more than double the breakout price. The bottom portion of the table shows how often price reaches a target using various heights. The prior example used the full height. In bull markets, that method works 71% of the time. For a closer target, divide the height in half and add it to the breakout price. That method works 88% of the time on average. For a check of the results, run it by table 40.3. The height is 5.13, and let's assume the current price is 17, so the height as a percentage of the current price is 30%. Table 40.3 says that 51% of the patterns in bull markets will fail to see price rise more than 30%. That value helps put the anticipated rise into better perspective. Trade inner head and shoulders. Since a head and shoulders chart pattern is part of the larger complex pattern, then trade the inner pattern. Buy when price pierces a down-sloping neckline, or use the inner right shoulder high, the armpit, as the breakout price. Usually this approach will get you in sooner and the signal is just as strong. Stop location. Before you take a position in the stock, consider the stop-loss location. Many times the various shoulder troughs will act as support levels. Don't forget to change the potential loss into a percentage of the buy price or anticipated breakout price. Many traders try to limit losses to 8%. Watch for throwback. After an upward breakout, the stock will likely throw back to the neckline. Consider adding to your position or placing a long trade once price stops declining. You should wait for price to rebound on a throwback, or else you could find yourself in a situation similar to that shown in figure 40.2. Price throws back to the neckline and then continues down for over a week. Depending on when you bought the stock, you could have seen a near 10% price improvement if you had waited a few days. Table 40.11 shows special features of the complex head and shoulders bottom. Neckline slope. The best performance comes from patterns with down-sloping necklines. Draw a neckline atop the highs of the chart pattern. When the neckline slopes downward, a close above it signals a breakout and a valid head and shoulders pattern. It allows you to buy into the pattern at a lower price than waiting for price to climb above the highest high. When the neckline tilts upward, the buy signal may never occur. Instead, wait for price to close above the highest high between the nearest head and right shoulder. Shoulder lows. I compared the lowest left shoulder low to the lowest right shoulder low. Performance improved only in bear markets when the left shoulder was below the right one. Experience. I prefer to trade regular head and shoulders bottoms instead of the complex variety. Over the decades, I made only 2 trades in complex bottoms. Big lots. First trade was in big lots big in 2004, shown in figure 40.5. After peaking in 2003, the stock began to slide and formed a complex head and shoulders bottom during the summer of 2004. I show that with 2 left shoulders S, a central head H, and 2 right shoulders S. The neckline sloped downward as the chart shows. The breakout was upward at A and looked normal, but breakout volume was weak. I considered placing a stop below the right shoulder low, but felt that location was too close, the first S in September. I scored the chart pattern using my scoring system, See Trading Classic Chart Patterns, Wiley, 2002, and it was 2. Scores below 0 tend to underperform. Lesson: if the scoring system has a score of 0 or below, either decide to abandon the trade or monitor it carefully. The stock climbed to B and threw back to the breakout price at C. On that day I bought and made an entry near the day's low. Yippee! I used lots of technical evidence to support an upward move in the coming days, including hope that this would bust a downward breakout from a large symmetrical triangle I saw on the weekly scale. I threw in some indicators, 2 MACD Bollinger Bands, Fibonacci retraces and extensions, all of which I no longer use. The busted downward breakout from the weekly triangle didn't happen. Price in the complex head and shoulders bottom continued lower. I sold at D and lost 7%. At E, the stock busted the upward breakout when it closed below the head low. The stock didn't drop more than 10% before reversing and closing above the top of the chart pattern. That happened at F, and it busted the head and shoulders for the second time. The stock continued to move sideways until May 2006, busting the pattern for the 3rd time along the way. This entry was bad timing on the throwback. Lesson: a good way to prevent buying too early after a throwback when price is still dropping is to wait for price to break out upward again. That means waiting for price to rise back above a down-sloping neckline or above the right armpit high when the neckline slopes upward. Had I done that, I would have entered the stock when price was rising at G, not falling. Because the stock wobbled sideways, I don't think it would have changed a losing trade into a winning one, but at least I would have corrected a bad entry. Chemtura. The second trade was in Chemtura SEM in 2008. I bought in after the second right shoulder was in place but well before confirmation. I put a stop below the right shoulder. The stock spiked down 2 days later and hit my stop. I lost 6% on the trade. 6% in 2 days. I really dislike losing money so fast. The complex bottom never confirmed and the stock dropped from my sale price of 6.96 to 9 cents before I stopped following the stock. Lesson: wait for confirmation. I didn't and suffered a loss. Sample trade. When the weather is nice, I like to take my bicycle out for a spin and give the automobile drivers something to aim for. On one of my bike trips I met Melody. After I told her what I did for a living, she confessed that she was a nightclub dancer and made oodles in tips. I was unsure whether I bought her story, but she looked pretty enough wearing a bike helmet and sunglasses, who can tell? Anyway, figure 40.6 shows a trade she made in the stock. I liked the setup because a trend line drawn from the high in early October 1993 to just after the head marked a turning point. That is where price moved up enough to pierce the trend line. Melody knew that price usually retests the low before beginning an extended move upward, so she followed the stock and watched it loop around and dip to 14. Then she glanced sideways and noticed the other dip at 14.38. That's when I found the inner head and shoulders bottom. A neckline connecting the rises between the two shoulders was impossibly steep. There was no way she could apply the traditional measure rule to determine a target price because price had not closed above the neckline. So she decided to buy into the stock when price closed above the right shoulder high armpit. She bought in late May 1994 and received a fill at 17.50. I wondered if another pair of shoulders would appear. They did. During late July, another shoulder appeared at 15.75, mirroring the one in mid-December 1993, the outer pair of shoulders. Soon, price began moving up. It climbed above the breakout price in mid-August. Now she was able to apply the measure rule for the complex bottom and found the target was 22.13. I didn't need the money immediately, so I held onto the shares as price climbed. I thought the stock had enough momentum to reach the old high at 29.25, so that became my target. As long as I didn't lose money, I was happy to hold onto the stock. She saw the stock building a base between 21 and 26 and wondered what to make of it. A downward breakout was a real possibility, so she raised her stop to 21 and at a price just below where the base was building. In mid-June, just over a year after she placed the trade, price zoomed up and reached her sell target. The stock sold at 29, which was fine with me because I needed the money for a down payment on a house. I was so engrossed with her story and the way she told it that I didn't realize she had dismounted from her bicycle. She spoke of going back to her place, of making some new chart patterns, and then playfully thrust her hips into mine. I fell off my bicycle.
Hey traders, big thanks for tuning in and listening to this audiobook here on Trading for Life. Your support keeps this channel alive and growing. If you found value in what you heard today, smash that like button, share it with your fellow traders, and hit that subscribe button so you never miss our future uploads. Let's keep learning, growing, and trading smarter together.